There's downside risk around labor, but then you also have to acknowledge that there's some upside price risk.
This oil price shock is another headwind to the labor market expansion.
The Fed will have to increasingly acknowledge the two-sided risks from this.
For now, the Fed is going to be cautious.
The Fed is going to be on pause. They do not want to preemptively react.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, it's decision day. Fed Chair Jay Powell confronting a major energy shock in the Middle East. As the industry is searching for workarounds to get crude flowing once again, Iran is vowing revenge following the loss of its security chief. That country isn't backing down.
And frankly, the killing of the national security chief, Ali Larijani, it seems to only muddy the waters further because he was believed to be the sort of next potential real leader that could coalesce power. If he is not available, who do they negotiate with? Who is going to be feasible to really put forward some sort of solution? And without that kind of solution, how exactly do you get oil and other commodities flowing through the Strait of Hormuz?
It's incredibly hard right now to get oil commodities flowing through the Strait of Hormuz when you have the Iranians saying, basically, the Strait, quote, won't return to its pre-war status. We need to design new arrangements. That's what the Iranians saying. Their oil is getting through, but for anyone else that wants a pass, there's going to be a new arrangement. And this is the big problem this White House and Western allies have right now in the region.
Which is why we're holding on to triple digits on Brent crude once again at 103.40. And that's the problem for the Fed Chair Jay Powell and the committee later on this afternoon. Not much has changed. Unemployment the last time they met, 4.4%. Unemployment now, 4.4%. The major change, one thing, the price of crude. Going into the last meeting, WTI was in the low 60s, and now it's $30 higher than it was back then.
Yeah, Brent's closed above $100 a barrel for 4 straight sessions, and we haven't really heard from Fed officials since this war really kicked off and gained steam, which is notable given the fact that it's been the quiet period. So we haven't gotten any indication about exactly how they're going to view this. Are they going to treat it hawkishly? And some people are worried to the point that you've been making. Is this going to be the classic central bank mistake where you see an oil price shock and you hike into it to curtail growth, or is there going to be a sense of patience and a sense of prioritizing any kind of weakness that you're seeing in the labor market?
A bigger question perhaps for the ECB, their meeting coming up tomorrow alongside the Bank of England and the BOJ. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research, with stocks looking to build on 2 days of gain. Stephen Cook of the Council on Foreign Relations as more strikes erupt across the Middle East. And Neil Dutta of Renmark ahead of the latest Fed rate decision. We begin this hour with our top story. Iran firing a fresh wave of attacks across the Middle East as supply chains scramble to reroute crude from the Strait of Hormuz. Joining us now for more, Bloomberg's Jemana Basechi, leading our coverage out of Dubai. Jemana, welcome back to the programme. Let's just start with energy and the rerouting, the offset, the attempt that people are making to try and take away some of the pressure out of the energy market in the Middle East.
Yeah, well, at the end of the day, you still got oil trading triple-digit territory here, despite the U.S.'s best efforts to ensure the safe passage of vessels through the Strait of Hormuz. I thought it was interesting that yesterday evening, the Iranian Foreign Minister, Abbas Araghchi, actually gave an interview to Al Jazeera where, to what Annmarie was saying, he was describing that in future there needs to be a new protocol. This is the exact word he used, vis-a-vis the safe transiting of ships throughout the strait. They clearly recognize that they have a lot of leverage with this choke point for global shipping and for global energy markets, and it is a point of leverage that they are not going to back down on. And if anything, they have been energized overnight. Post the killing of Ali Larijani, this was a key figurehead. As we spoke about yesterday on the show, there's now confirmation from Iran that he was indeed assassinated. So more decapitation right at the top of the political structure. And they have vowed retaliation for that. And the retaliation has indeed come overnight. Around the same time as they announced that he had been killed, they launched a series of attacks, once again, on Gulf states. Over here, I can tell you in the UAE, we received multiple missile alerts on our phones overnight. There was even damage sustained by an Australian military base overnight too. The interception rate continues to be quite high, but at the end of the day, they continue to target many of the military bases and even civilian infrastructure within the UAE. Also, renewed attempts in Saudi Arabia, the diplomatic quarters there, they intercepted some missiles on the eastern oil fields. Another attempted strike on the U.S. Embassy in Baghdad, and also attempted strikes on diplomatic areas in Kuwait as well. So the backlash continues, and then also reports out of Tel Aviv that There have been 2 announced deaths from these strikes that took place there too. So no signs really of things letting up. It is day 19. The Iranians continue to retaliate, and they continue to put pressure on that key choke point for global shipping and energy markets, and that is the Strait of Hormuz. And unclear at this point whether the U.S. can actually get together the coalition that it needs to ensure the safe passage of vessels through the strait, and whether even that's feasible technically.
Day 19 and no visible off-ramp. Jumana, always good to see you. Jumana Basechi out of Dubai, leading our coverage out of the region. Just to pick up on that line from the Iranian foreign minister, Annmarie, to go over this again. We need to design new arrangements for the Strait of Hormuz and the way ships pass through it in the future. At the moment, the path of transit and the flag on the vessel, highly conditional at the moment.
Absolutely. Iranian crude is getting through, and 90% of that is going to China, some Chinese vessels. There have been also pockets of some Indian vessels and Pakistani vessels getting through. If they are in advance communicating with this regime, not a single Western vessel is able to get through. And to be honest, what CEO is going to okay that, given the fact that the strait is not safe right now? Now the Iranians are talking about, we own this. They do not view this as an international body of water anymore. That is why the strait is not closed. It's controlled.
Brent crude right now, 103.40. Here's the view on Wall Street this morning. Ed Yardeni of Yardeni Research writing, sentiment heading south usually increases the likelihood that we'll get a good buying opportunity. It's worked very well for me in the past, but it may not work now. Ed joins us now for more. Ed, welcome to the programme. That's an interesting line from you, so let's build on it. Why is it different this time?
Well, in the past, whenever the bull-bear ratios took a dive, that was a great contrary indicator that it was time to buy. And usually in the past, when the bull-bear ratio took a dive, it was because there was some sort of crisis that there could be a response to by fiscal and monetary policy, trade policy. In other words, there were policies that the government could implement that would relieve all the concerns, relieve the crisis. And more often than not, what we've seen in the past, it was a credit crunch that spooked the financial markets. And sure enough, it led to a recession. And sure enough, it led to fiscal and monetary stimulus, which reversed the whole situation. So we saw that back in 2009. We made a bottom when the Fed came in. We saw that with the pandemic when the Fed came in. So we've got plenty of examples of the Fed put and the Treasury put and so on. The problem here is who's in charge, who's in control, who can respond to this latest Middle East crisis? And the answer is nobody. It's kind of ambiguous about how this thing gets resolved. I think the markets have taken a pretty optimistic view that this isn't going to last very long, and that markets will adjust, that there will be oil, and maybe it won't be a 20% cut in global oil as a result of the Persian Gulf War, but more like 10%.
The conclusion seems to be, Ed, from the bull case at least, because we hear it all the time on this programme, is that the earnings profile of the S&P 500 is still pretty decent. The tailwinds coming into this year are pretty strong, and that we can withstand the pressure coming from international waters, coming from the Middle East. Ed, do you not think that they can stand up to those kind of forces?
Well, I have been pointing out that the market has been amazingly resilient. I think we all have. And the explanation for that is that increasing concerns about a possible recession resulting from all this have, in fact, weighed on the forward PE of the S&P 500. But on the other hand, the industry analysts that cover the S&P 500, guess what? They didn't get the memo that there's a problem in the Middle East that could depress earnings. And so what we're actually saying is earnings expectations are going up for this year and certainly for next year. So, I think the analysts are probably right. This isn't going to last for more than a few more weeks. And if you look out to 2027, the outlook is actually pretty spectacular for earnings for all sorts of reasons.
How much is the earnings outlook going forward predicated on the idea of credit markets remaining open and, frankly, relatively easy in terms of financing conditions?
Well, I think the issue here in terms of there's sort of layers of risk here. I wasn't particularly concerned about the the private credit markets. I, saw, like everybody else did, that there's cracks in the private credit markets, and through those cracks, Jamie Dimon, the boss of JPMorgan, said, hey, you can see one cockroach, and if you see one, there's probably a lot more behind it. And sure enough, there have been more cockroaches in the private credit market. But I think it's not, the problem is not the nature of what happened in 2008. However, if you lay on top of that uncertainty about how this war goes and whether it will, in fact, create a stagflationary shock that could come back to create more cracks and more cockroaches in the credit markets, then you got a problem. So, about a week and a half ago, 2 weeks ago, I raised my odds of a recession or just all sorts of possible problems from 20% to 35%. Market didn't care. It's held its 200-day moving average. It's actually pretty normally. And look, I view corrections as buying opportunities, and the market's not giving us much of a buying opportunity, quite honestly.
Ed, if we do get a hawkish tone from the Fed today, given what you just talked about with the response and what borrowing costs do in the face of what could potentially be a stagflationary shock, could that potentially create some real downside, given the fact that it would introduce this possibility of more cracks ahead?
Well, Lisa, you know what I wish the Fed would do? I wish they would put out a statement and say, folks, there are just some things that we can't solve. Monetary policy can't do everything. And this is a geopolitical shock. We can't do much about that. We're going to have inflation surge here for the next few months. First, we got energy prices up, and then we got a shortage of fertilizer, so food prices could go up. And there's really not much we can do about that. Raising interest rates isn't going to make those problems go away. It will create another problem, which is an even weaker labor market. So I wish they just, not be hawkish or dovish, but be honest and say, folks, we just, this is a problem created by geopolitics. Fiscal policy hasn't been very helpful on the inflation front and the debt front. And all we can do is leave the rate right here and see how things unfold.
Ed, that's what you want them to say. What do you think Jay Powell's going to say?
Well, I think they might say something kind of a toned down version of what I just said, and that, they're going to have to just wait and see. They're data dependent. They have to see how this plays out. I guess if they want to go Volcker on us, they would say, look, we've got a problem here with rising risk of inflation and rising risk of unemployment. Eeny, meeny, miny, mo, we choose to be more concerned about the risk of inflation because we don't want to monetize inflation the way we did in the 1970s. And then Volcker had to come in and slam the brakes to get a recession to bring inflation down. We don't want to go down that road. So we're kind of inclined to think about the possibility of raising interest rates, which is something the markets, nobody really expected to be on the table prior to the war. But again, I think they're going to just say we're going to keep the pause going for a while.
Well, Chair Powell definitely ain't Volcker. Ed, good to see you, sir. Thank you. Ed Yardeni of Yardeni Research. This Fed has missed its inflation target every year since the pandemic. I don't think that's going to change anytime soon.
It's been more than 5 years. It would be interesting if suddenly it mattered that much more at this moment. That said, there is a specter of discomfort that you're feeling across Wall Street, where this dip doesn't feel like enough of a dip to offset all of the concerns that Jay Powell has to respond to, whether or not he's there in a couple months' time.
That decision this afternoon, 2 p.m. Eastern Time. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Good morning, John. Iran vowing revenge for the killing of one of its top leaders. Iranian state media confirming that Ali Larijani was killed in an Israeli airstrike on Tuesday. He was the most senior Iranian official to be killed since Supreme Leader Ali Khamenei on the first day of the war. Meanwhile, Brent prices eased earlier but have turned higher again. It pulled back after Iraq signed a deal with Turkey to resume oil exports. through their territory, allowing it to avoid the Strait of Hormuz. Iraq will relaunch a pipeline known as the Iraq-Turkey pipeline, connecting Kirkuk to Turkey's Ceyhan port. And Japan's Prime Minister Sanae Takaichi warning she's facing a, quote, extremely difficult meeting with President Donald Trump tomorrow. Her comments coming after President Trump criticized Japan for rebuffing his demand for warships to help secure the Strait of Hormuz. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara later on this morning. Up next on the program, come and get a loan in the Gulf.
We don't need too much help, and we don't need any help, actually. In fact, we just put out a notice. So this was a great test, because we don't need them, but they should have been there.
Up next, we'll catch up with Stephen Kirk of the Council on Foreign Relations. Live from New York City this morning. Good morning. Back-to-back gains on the S&P 500, the first two-day winning streak on the S&P since this war started. For the month of March, equities add to those gains, up by 0.5% on the S&P, on the Nasdaq up by 0.7. Brent and WTI shaping up as follows. Brent crude holding above triple digits, 103.40, and just about unchanged on the session so far. Unique yesterday, the crude still inched higher and equities did okay.
It seemed like it was the volatility in crude that was more important than necessarily the absolute level. We've survived $100 a barrel before in the United States. We saw that on average from 2011 to 2014 around that level. The fact that you could get some calm is enough for people to say maybe it's a buying opportunity.
A bit of relative calm so far this morning. WTI 94.71. Under surveillance this morning. Go and get a loan in the Gulf.
We don't need too much help, and we don't need any help, actually. In fact, we just put out a notice. I was watching over the last couple of weeks, and all of our NATO allies were very much in favor of what we did. So I think NATO's making a very foolish mistake. So this was a great test, because we don't need them, but they should have been there.
So here's the latest this morning. The president slamming NATO allies after failing to get their support for a coalition to reopen the Strait of Hormuz. The president saying the war will end in the very near future, while threatening more attacks on Iran's oil-rich Karg Island. Bloomberg's Tyler Kendall joins us from the White House for more. Good morning, Tyler.
Hey, John, good morning. Well, President Trump appears to be abandoning his call for allies to help secure the Strait of Hormuz after many appeared wary of his demands to send naval escorts. When asked directly whether any countries are going to send assets to the strait, I think it's fair to say President Trump sidestepped the question, instead touting bilateral relations between the U.S. and countries in the Middle East before going on to say how disappointed he is in the NATO alliance. In fact, it's really highlighting what's been past strained relations between the Trump administration and traditional allies when it comes to defense spending, as our own analysts at Bloomberg Economics say that for our European partners in particular, they're caught right now between constraints when it comes to capabilities and politics, but also this concern that the White House could disengage when it comes to the conflict with Ukraine if they don't engage when it comes to the conflict in Iran. In fact, yesterday, President Trump multiple times brought up unprompted the conflict in Ukraine, at one time saying, quote, "We've helped them in Ukraine and they won't help us in Iran." Comes after new yesterday, the French President Macron confirmed that his country will not be sending assets to the Strait of Hormuz, but says that France remains ready once the situation is calmer. It appears a ceasefire is going to need to be in place in order for this coalition to be formed, as many allies have said that they're not a party to this conflict, and NATO in particular is a defensive alliance. But John, as you well know, of course, President Trump's call has extended beyond NATO countries to China, to Japan, as we get ready for tomorrow when Japanese Prime Minister Takaichi is expected here at the White House. This trip was planned well before the conflict in Iran started and comes as big oil refiners in Asia start to look to import crude from elsewhere outside of the Middle East, as it seems that disruptions show no sign of slowing.
And that meeting could be awkward heading into the weekend. Tyler, thank you. Tyler Kendall with the latest from outside the White House. Stephen Cook of the Council on Foreign Relations writing, the U.S. still does not seem to have an answer for the Strait of Hormuz. What seems to be shaping up with a full-on military effort to open it will take weeks. Stephen joins us now for more. Stephen, welcome to the programme. Let's take a step back and talk about the operation's goals. They've been through this a few times. Take out any potential nuclear capabilities, missiles, the Navy, the industrial base that underpins it. How much progress have we made, and what phase of this operation are we now in?
That's a great question. And when you talk to military professionals and professional military analysts, they will tell you that despite all of the noise and sort of doom and gloom that you get in Washington over a situation like the Strait of Hormuz, the United States has made a fair amount of progress in degrading Iran's military capabilities, and which will have a lasting effect on Iran's ability to project its power. The problem remains that there is still a drone and missile threat to America's partners in the region. Just yesterday, the Israelis took a fair amount of fire in response to the killing of Ali Larijani. And after a lull, Gulf states were getting hit as well. So there are still threats out there from the Iranians. There is a timeline. The military has a timeline. The Israelis have a timeline. It is 4 to 6 weeks for them to get through their target list and all the goals that they'd like to achieve. Yet the president is out there once again saying that this could end very soon.
Well, Stephen Cook, last night, CENTCOM employed 5,000-pound deep munition bombs on the coast. At the same time, we have the USS Tripoli, which is an amphibious Navy ship with tons of Marines heading to the region. What do you think the president plans to use this group of individuals for?
Well, part of what's shaping up is that the president threatens military force or actually uses military force in an effort to intimidate the Iranians. Thus far, the Iranians have not been intimidated. So this movement of U.S. Marines to the region may be, in fact, part of this effort to intimidate the Iranians. But they can be used to capture Kharg Island or to capture the shoreline along the Iran shoreline along the Strait of Hormuz. That is something that has become more openly discussed in recent days as the Strait of Hormuz has become more and more of a problem for the United States.
If the United States was to capture Kharg Island, what would that mean for the regime? Because that basically cuts off their entire economy, no?
Yeah, I mean, the Kharg Island is obviously a lifeline for Iran. Iran has a bigger economy. It's not just an oil-based economy, but with the Emiratis moving, or at least discussing the possibility of cutting off all of Iran's assets in Emirati financial institutions, and then if the United States were to take Kharg Island, you would really cut off the regime. The problem with that is, of course, is that the Iranians would be expected to retaliate, not just to try to push the American presence from Kharg Island, but would clearly try to attack oil infrastructure, production facilities, storage facilities, refining facilities, export facilities throughout the Middle East, which would extend the crisis and raise the prospect of a prolonged period of elevated levels of oil and gas at the pump for Americans.
Stephen, do you think that NATO is going to survive this period?
Well, this is, I think, a real test, and one has to question. I think that the fact that the NATO allies who are not consulted on this conflict, don't support this conflict, and have resisted the president's entreaties to help ensure the freedom of navigation through the Strait of Hormuz is going to put a lot of pressure on NATO. It will reinforce the narrative of the president, the people around him, and people who are supporters of Make America Great Again, that the United States wants partners, but it wants capable partners. And I think this will once again make the case for the president and the people around him that the Europeans are not strong allies, and that the United States should look for capable partners outside the alliance.
Stephen Cook of the Council on Foreign Relations. Stephen, good to see you. There's no right answers here, obviously, clearly. A really difficult position to be in. The problem I think the US has with their allies right now is that this is something, if the regime collapses, that all of their allies will benefit from. But none of their allies wants to have anything to do with this, which is why it's festered for years and years and years.
There's been a complete realignment of the power dynamics of global relationships, and Europe has been on the losing end of this. A real question of what it looks like on the other side, and this is really a catalyst type of moment.
Coming up on the program, we'll catch up with Dan Pickering of Pickering Energy Partners on the risk of $125 crude. Plus, Yahira has your morning movers. Memory stocks jumping on AI optimism. More on that in just a moment. Back-to-back gains on the S&P 500, adding to them this morning. We're up by 0.5% on the S&P, on the Nasdaq up by 0.7. We'll get to the tech theme in just a moment with some single names. But let's turn to crude, because these gains built up yesterday even with the crude rally extending. Brent crude 103.50, just about unchanged on the session. WTI around 95. And interestingly, yesterday, leading the pack on the S&P 500, discretionary and energy. Make sense of that. OK, that's the stock market. That's crude. Let's turn to the bond market. 2s, 10s and 30s. Going into the Federal Reserve decision later on this afternoon, yields backing away, retreating from the high of the year, the high range of the year, high end of the range of the year. 430, those kind of levels, up in the upper 420s over the last week, back down to about 418 going into Chairman Powell later this afternoon.
There still is a sense that there will be an open door to at least one rate cut. That's at least is what's priced into the market. There also is a reassessment. And how many people have come on this show and said, either way, buy bonds, because either the Fed's going to get this wrong and they're going to keep rates too high or even hike them, and that's going to cause a crash, buy bonds, or they're not, and the oil shock's going to be transient, and essentially it will be washed out and it will be transitory. So buy bonds. And that's essentially why you're getting this incredible bid with a 20-year auction yesterday that was incredibly strong.
We've heard that from Neuberger Berman. We've heard that from JPMorgan. On this show, we've heard it from so many others as well. As we count you down to the opening bell, about 3 hours away, let's get those single names in that tech theme. Yahara has more. Hi, Yahara.
Hi, John. Well, we start with Alibaba. Their ADRs are up 3.6% after a string of AI headlines overnight. First, the company is consolidating its AI operations under one roof to drive faster profits. Plus, it said it is hiking prices on some of its key AI services. All of this suggesting strong demand, plus a clear path to monetization, something investors have been quick to reward since these companies, these tech names, have been spending so aggressively on AI, and investors want to see a return. Meanwhile, take a look at this board. These are some of the best performing stocks this year, and they're all higher this morning. Micron, SanDisk, Western Digital, all higher as they ride this wave of surging demand for memory chips due to AI. But the real test comes later today when Micron reports after the bell, and with the stock up nearly 60% year to date, it will be all about whether it can deliver. And we end on a mover to the downside, and that is Lululemon. Shares are down nearly 2% in the pre-market after forecasting a second straight year of profit decline. Sales also missed as shoppers reached for markdown items instead of full-priced ones, and they did not deliver the CEO announcement that many were anticipating, so still without a permanent leader. John?
Yahara, thank you. More from Yahara later on this morning. Some comments, some headlines coming from the Israeli defense minister in the last 20 minutes or so. They say this, that the Iranian intelligence minister has been killed, going on to say that the IDF is authorized to kill any senior Iranian official. And the headlines on that front keep building.
They keep building. This is another massive blow to the regime this morning. Yesterday was a huge one with the security chief, Ali Larijani, an individual that has touched almost every part of Iranian society. And now the intel chief. Reportedly, the Iranians are saying, the Israelis are saying that they killed this individual. This was a very close ally of the former supreme leader, Khamenei.
That's the latest coming from the Israeli side this morning. On our radar this morning, the president blasting NATO allies after failing to get international support for opening the Strait of Hormuz. Trump saying the countries are making a, quote, very foolish mistake and the US doesn't need their assistance. Elsewhere, the president confirming his planned summit with China's Xi Jinping has been postponed as the Iran war stretches on.
It looks like it'll take place in about 5 weeks. I look forward to seeing President Xi. He looks forward to seeing me, I think. But I do look forward to seeing him. We have a good relationship with China.
The president did not announce a date for the meeting. And finally, Oaktree's Howard Marks saying markets are underestimating the true impacts of AI.
A company called Block, which had 10,000 employees, announced that 4,000 of them were out. 40% of the workforce gone in one day because AI could do the work cheaper and faster.
You might recognize the individual sitting alongside Howard Marks there. Bramo, how was the conversation?
It was actually fascinating. There were three things that I took away from it. Number one, no one at that meeting, and Howard Marks, was not talking about the war. And when I asked him offline about the war, he said, I've got nothing intelligent to say about it. And sometimes the most intelligent thing you can say is, I don't have anything intelligent to say. No one can predict anything. What everyone's asking about very much is credit markets and what we're seeing in software. Is this endemic of something else? He went to say, ultimately, it does feel pretty complacent right now, even with some of the kinks that we're seeing in private credit. He's saying, how can you game out the uncertainty of a truly revolutionary technology that people are underestimating at this point? And he went on to say he'd rather own the equity than the debt of these companies because you don't have any upside. You just get your money back if you're lending. He doesn't understand the idea of a 100-year debt to Google. He doesn't understand the idea of a 40-year or 30-year debt. How can we understand what's going to happen in the next 5 years?
That's quite a statement from the legend of a credit market, right? Which is basically, I see the opportunity outside my asset class.
Not only that, but he was talking about how we haven't seen a credit cycle in a long time, and credit cycles don't die. And he was talking about incredibly frothy opportunities, spreads that look pretty historically tight. And he said he remains cautious until people start to really feel fearful. And right now is not a time of fear. And I think that that's a really important kind of reckoning and a reason why people are so uncomfortable right now with buying the dip blindly.
We've heard something similar from Apollo as well. If you want to watch the full exchange, available, of course, on Bloomberg.com and on the Bloomberg terminal. Let's turn back to energy. Crude sitting in the triple digits as the industry searches for workarounds to get crude flowing once again. The president maintaining lower oil prices are on the way.
As soon as that war's over, which will be soon, your prices are going to drop like a rock. You watch.
Dan Pickering of Pickering Energy Partners writing, if the US just stops, then Iran holds the keys to chaos by threatening future straight shutdowns. This would create a perpetual risk premium on oil prices. Dan joins us now for more. Dan, welcome to the programme. Let's build on that last line. It's important. Do you think this is regime change for the price of crude?
It's certainly putting a lower floor in on crude, and it really does depend, as Annmarie was saying, it depends on things that are very difficult to understand and predict. And so if we end the war in Iran without some sort of definitive action that controls the Straits of Hormuz, there's going to be a higher price to crude. Is it going to be triple digits? Not necessarily, but it will certainly not go as low as it's been recently.
Dan, we've watched the dominoes fall over the past 2 weeks. As the energy couldn't move through the Strait of Hormuz, production started being cut, and now we're in a different phase. They're finding workarounds. First it was the pipeline, the East-West pipeline in Saudi Arabia. Now there's other workarounds too. What phase are we in at the moment?
Yeah, as the market tightens, everyone looks for alternatives. Sooner or later, you can't tweak around the margin, and the problem remains. 15% of global supply is offline. You draw down inventories, you try to reroute pipelines, but that's just too much oil to work around. And so at some point, and that point is months, not quarters, at some point, price is going to have to solve the supply-demand equation. And that price isn't where we're at today with WTI near 100. It's going to be 20 or 30% higher.
So what is the oil market right now pricing in, given the fact that there is a high likelihood that this conflict is going to go on for at least another couple of weeks?
Yeah, I think in a couple of weeks, I stopped looking at the front month or the near-term spot prices because those are wildly volatile and move with news flow. I look out to the 2027 and 2028 crude futures, which have moved from, call it $60 a barrel WTI, up into the sort of high 60s, low 70s. That tells me that the market's decided there's $5 to $10 longer-term premium that's coming in because of potentially how this situation winds up.
There are two schools of thought, Dan. On one hand, some people say there will be a higher long-term price simply because there'll be hoarding and a premium on some of these physical goods. Other people say that if the short-term situation, if the short-term conflict does get worse, escalates and creates really high energy prices, that actually will drive prices down incredibly low on the back end of this conflict. Where do you stand on that?
Yeah, the issue of the higher it goes, the more demand destruction you have, the longer it takes to recover from that. So the higher it goes, potentially, the lower it falls. Where I stand on this is that it is all about the duration. If the straits are closed for 6 months, we're going to have $125 oil for quite a period of time. We're going to have economic issues, probably a recession. If we solve this in the next couple of weeks, we probably come back down to the 70s. Gasoline prices come back down to reasonable levels. and we're sort of back to a new normal where gasoline and oil are a little bit more expensive, but not dramatically more expensive.
Dan, what's the gap right now between the physical market and the futures market? Because I'm looking at Oman and Dubai crude, and they're $55, $60 higher than where Brent is trading.
Yeah, if you have to own the physical barrels, you are paying a significant premium over the financial markets to get them. I think the financial market's 10 times bigger than the physical market. So financial markets pricing where you can trade paper barrels, if you are trying to get a barrel in the Middle East, you're paying more. You know, same story with jet fuel and other products. So there are signs of physical supply tightness that is not being reflected in the financial markets. That has happened historically as well. So it's not unusual, but it does say that the physical market quite tight.
If we have a prolonged shut, or the Iranians continue to control and not allow most vessels to go through the Strait of Hormuz for a prolonged period of time, will the physical market, or the futures market rather, catch up to the physical market?
It'll certainly drag the financial markets higher. Right now, you're pricing out demand in isolated instances with that $150 crude in the Middle East, for instance, on the physical market. The financial market's going to move up to the same spot and pull basically prices worldwide that direction. And if that happens, then we will start to see, we will price out the 5, 10, 15 million barrels a day that we are not able to get through the straits.
Dan, what would happen if Iran turned around and said any vessel with a Chinese flag on top can come through, no problem? Would that change things materially?
I think what we'd see a lot of Chinese flag vessels moving through the straits. And I mean, the market's efficient. It'll move quickly to have China be the source of shipping through the straits. But I do think we'd see near-term prices drop. And I'm a believer that when this conflict ends, regardless of how it ends, near-term prices come down because more oil will flow. So whether it's Chinese tankers, a U.S. flotilla, protection, regime change, et cetera, however it ends, prices come down, more oil through the straits, prices come down. The question is, come down to what?
Well, Dan, this is what I'm trying to work out, though. Where's the pressure point and who holds the keys? And ultimately, it feels like the pressure point's going to be in China. It's not going to be here in the United States, and they hold the keys. They can get the Iranians to come around. Now, am I reading it wrong? Are other people reading it wrong? Is there a path there to reopen things?
Yeah, so China and India both approached Iran and said, let us take tankers through the straits. That's another gambit in the strategy. The question is, how long does that last, or does the U.S. allow that? Ultimately, are you going to feel comfortable with Iran in charge of the straits and allowing some vessels to come through, but not all? Do we wind up with this uncertainty premium that creeps into the market, even if barrels do start to flow to Asia?
Dan, it's good to see you. Thank you, sir. Dan Pickering there of Pickering Energy Partners. I think there was a hope going into the weekend and initially coming out the other side of the weekend that was the direction of travel. I'm not sure if that's misplaced hope or not.
To your point, regardless of the political backdrop and what ultimately happens in terms of who controls the strait, in the near term, if Chinese barrels can get through in a real way, that could lower the prices and then allow this conflict to continue at the level that it is without necessarily disrupting the oil trade on a mass level. I mean, this is sort of one question that people have as people try to look through this as much as they possibly can in markets.
The only other issue, of course, is that it's not just Iran. Oman and the UAE are also bordering the Strait of Hormuz. And the UAE certainly doesn't want this to become Iran decides who goes through and who doesn't. And yep. Dr. Anwar Gargash spoke to Ethan Brahmer, our Israeli bureau chief at the Council on Foreign Relations, as he said the UAE may be willing and wants other nations to join this coalition because they want this to remain an international body of water. They do not see a future where Iran decides who gets to go ahead and who doesn't.
Multi-dimensional geopolitical chess right now in the Middle East. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump abandoning his efforts to recruit partners for the war in Iran. The president criticizing NATO allies for their lack of military support to reopen the Strait of Hormuz. Most countries showed little willingness to join the mission, which military analysts say would be risky without a ceasefire. The Pentagon is working to develop alternatives to Anthropic's AI tools. A senior U.S. defense official telling Bloomberg the move comes after the Trump administration's decision to declare the company a supply chain risk in a feud over safeguards governing military use of the technology. And Boeing signaling that several performance issues will weigh on its first quarter results. The plane maker saying it's delivered fewer wide-body aircraft than planned. It also said wiring defects on the 737 MAX are a headwind for this year. Boeing is now pushing back by a year its goal of generating positive margins at its key commercial plane unit. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. Up next on the program, facing new risks.
There's downside risks around labor, but then you also have to acknowledge that there's some upside price risk. So it makes it very difficult for the Fed. It's a little too soon for them to really come down on one side or the other.
Up next, Dutta of Renmac, live from New York City. You're watching Bloomberg TV. Could be a long day in financial markets, and that news conference later on could be an absolute snooze with Chairman Powell. I can tell you, journalists will do their best to make it interesting. He has got one mission, one goal: to make this very boring later on this afternoon.
Journalists, meaning us. We're going to be right here trying to listen to any kind of clues. He's going to be trying to be boring at a time when this market is anything but, this economy is anything but. And it's a real difficult thing because on one hand, people are looking for a policy response, and the Fed is ultimately going to tell us we don't have one for you. Ultimately, we cannot be the person who steps in and provides any comfort. So it has to come from the White House. It has to come from conflicts. And right now, people can't price that in, so they're just ignoring it.
Just to clarify, our show's going to be great.
Of course.
The news conference is going to be boring. And the journalists in the news conference will try and make it interesting.
You know, John and Tom are going to be doing a duo, a tap dancing duo. You should stick in. It's going to be to the Fed dot pattern, and it's going to be absolutely
Stop
wonderful.
pretending TK watches the news conference.
What does he do during that? Does he go out for like a drink or something?
TK is somewhere else. Right now, equity futures on the S&P firmer by about 0.5%, on the Nasdaq up by 0.6%. Under surveillance this morning, facing new risks.
There's downside risks around labor, but then you also have to acknowledge that there's some upside price risk. So it makes it very difficult for the Fed. It's a little too soon for them to really come down on one side or the other. That's one way they can kind of communicate almost a little bit of a dovish bias, because they're saying, yes, there are some, more upside inflation risk, but we're not really taking away the cut that we have in later this year.
Here's the latest this morning. The Federal Reserve set to deliver a rate decision and new set of projections while facing triple-digit crude prices. Dutta of Renmac writing, we're on track for 3 poor core inflation prints in a row ahead of a shock to oil markets. I think it's more likely that a cut is erased altogether. Neil joins us now for more. Neil, welcome. Was looking forward to this. So let's go from the top. 2 p.m. Eastern Time, projections drop. What changes?
Well, I don't think that the Fed will be as dovish as they have been if you judge it based on the summary of economic projections. If you just think about this in terms of mark to market and you're a forecaster, it's more obvious that they need to revise up their core inflation forecast. Core PCE is basically tracking above 3% as of this meeting, and they expect it to go to 2.5% by the end of the year. In order to hit that bogey, you need core inflation prints, I think around 0.2% for the rest of the year. That's a pretty tall order, all things considered. We haven't even seen the flow through of energy into core inflation, and some of that will bleed in, not a lot, but that's going to happen. And so, if you're looking at this objectively, I think you just have to say it's much more likely that they'll be revising up core PCE inflation. It could be as much as 0.3%. Then revising up the unemployment rate estimate, which basically stays at 4.4%. So you put that into a simple Taylor rule model, John, and, I think 30 basis points higher on core inflation, that's probably good for enough of them to take a rate cut off the table.
Neil, you've been pounding the table about the labor market and saying that it is much weaker than people are currently giving it credit for or lacking the credit of. I'm just wondering, what do you think the consequence of a Fed remaining on hold is for the economy?
Well, it's not good. It's not good. It reinforces the downside risk to the job market. Ultimately, if the unemployment rate is going up and the Fed isn't easing providing some kind of shock absorber to that, it just reinforces the upside risk to the unemployment rate.
Do you think that it increases chance of recession this year, which ultimately no one is really pricing in?
Yeah, I mean, I think that the risk of recession is higher than the markets believe. Of course, I've said that for some time now. But, look, at the end of the day, the economy is not in the same place it was in 2022, which is why drawing parallels to that period, I think, are misplaced. I mean, back then, the labor markets were strong, real incomes were rising. Today, that's not the case. Real incomes net of transfers are running basically 0.5% over the last year, and that was true even before this latest inflation shock. Of course, back then, we had a massive pile of excess savings that consumers were able to draw down. Again, that's not the case today. The savings rate, if anything, has already been drawn down. I mean, that's one of the reasons why consumer spending has been as strong as it has been over the last 12 months or so. And even then, consumption has been slowing despite that drawdown in savings. So I think that the consumer here is on, not as strong footing as was the case a few years ago. And, it's encouraging to see oil prices moderate somewhat today. But ultimately, we're on a glide path nationally to $4 a gallon gasoline. I mean, that's likely to happen at some point in the next week or two. So that provides some sticker shock, I think, to consumers. And one thing we're not talking about? We're not talking about tax refunds anymore. So a lot of the enthusiasm that people had going into the year, I think, has been effectively neutered as a result of this.
Well, Neil, in some states, we're already above 4. In the president's own Florida, we're at 3.93 when it comes to a gallon of gasoline. You said going into the weekend, the two core pillars of Trumponomics are rising equity prices and low energy prices. Are we at risk of losing both of these at this moment?
Well, I mean, I think we're losing for households, of course, the main issue is that, even though America is a large energy producer now, the money doesn't recycle back into the economy quickly. So consumers will spend less than oil producers will spend more, at least in the short run. So I think that's something that people need to think about here is that, the sort of the elasticity of the spending. It's not like oil producers are going to take their newfound income windfall and go out and spend in a bunch of mining rigs. I mean, in fact, to the extent that people are saying this is going to be transitory, they may be less inclined to do that. So I think the growth shock is actually that much more material, at least up front. But with respect to equities, look, equities are hanging in there. I mean, there's some, there was probably some anxiety before all this. So even if you get a quick resolution to this, I mean, I don't think we're sort of like raging back to new highs. But for now, I mean, the stock market is, for lack of a better phrase, trusting in Trump.
Neil Dutta, it's good to see you, sir. Neil Dutta there of Renmac on the trust in the president right now in this equity market. An equity market is still very, very close to all-time highs. Coming into this year, we're going over old ground here, I know, but we were set up quite nicely. Lots of tailwinds coming into the new year. Reasons for consumer confidence to inflect, to bounce, to pick up a little bit coming into 2026, into spring selling season in the housing market with mortgage rates coming down. Now anxiety starts to build for different reasons, and you wonder to what extent this move in crude does upend the year ahead.
And the reason why people aren't necessarily leaning into the idea of this being totally disruptive is because they've seen this movie before. Remember Liberation Day in April? Oh, the world is falling. Oh, wait, it's not. It's actually an incredible buying opportunity. And there's so many people seeing more parallels with that than, say, a 1970s type of scenario.
Conditioned to buy.
Yes.
Equity futures right now up by 0.4% on the S&P in the next hour. Priya Misra of JPMorgan, Seth Jones of CSIS, Jeff Currie of Carlyle, and Brad Rogoff of Barclays from New York City. You're watching Bloomberg TV.
Trying to forecast the path of this Middle East conflict is incredibly difficult.
Investors still have risk appetite.
If you're selling equities today, there's a real chance you could get whipsawed.
Trying to gauge what the trigger points will be is very difficult.
We don't have a lens on when this is going to end. Nobody does.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And the price action, the scores look like this. Equity futures on the S&P holding high, holding steady, up by 0.4% on the S&P 500. On the Nasdaq, up by 0.6, adding to back-to-back gains on the S&P 500 in the previous two sessions. In the commodity market right now, Brent, WTI look like this: 103.84 on Brent, 4 consecutive sessions north of 100 for Brent crude. Can we make it day 5, up by 0.4%? Heading into this event later on this afternoon, a Fed decision, a statement, projections, and news conference with Chairman Powell at 2:30 Eastern Time.
Here's my proposal. I think that they should have a dartboard. They should have some darts. They should have some potential targets for inflation and growth. And they should just play a game, because ultimately they don't have any edge on what is unknowable right now. They haven't spoken since the war in Iran really did pick up. So they can't really comment necessarily. They haven't been commenting on oil prices, a sense that we won't get back to lower pricing in oil unless there is a ceasefire. And frankly, Jay Powell is not going to be answering questions on when the ceasefire is going to happen. In fact, he's not even going to be answering questions about his own future.
So the news conference is always, to me at least, about emphasis. Where is the emphasis going to be? Does he place more emphasis on the labour market data recently? That labour report was ridiculously soft. Or does he put more emphasis on the inflation risk that's on the horizon? One or the other right now is going to indicate to this market where the committee's leaning at the moment.
If he came out and he said history typically hasn't been kind to central banks that raised rates into an oil price shock, this market would say hallelujah, and it would rally tremendously. If he comes out and he says CPI, core PCE, has been above target and is inflecting in the wrong direction, we are very concerned. This oil price shock only adds to those concerns. It does raise the prospect of two-sided risks, either a rate cut or a rate hike. This market will freak out, and that is ultimately what you are dealing with later today.
This market's not freaking out right now. 103.80 on Brent crude, around 95 on WTI. The focus on the pressure points in the Middle East and the release valves. We've talked a lot about these pipelines and some of the shipping that is making its way through the Strait of Hormuz. It's just little headline after headline continuing to build.
It's certain individuals, and as you've been rightly talking about, it's certain vessels that have certain flags, Chinese flags. Obviously, Iranian crude is being let through. Some Indian vessels are being let through. Some Pakistani vessels are being let through. Maybe 1 or 2 Turkish vessels being let through. But it's small, and it's not enough to impact the price of oil right now in terms of trying to depress where the price is right now. Until the Strait is fully opened and not controlled by the Iranians, we will not have that release valve. And what the Iranians are saying right now, the foreign minister gave an interview last night and says, we need a new protocol for the Strait of Hormuz. We are not seeking a ceasefire. The head of the Speaker of the Parliament said yesterday we are not going back to normal when it comes to the Strait. And this is why you see the administration and the Israelis continue to attack their military targets.
And why crude is still around triple digits. Big hour coming up. Coming up on the programme, we'll catch up with Priya Misra of JPMorgan as equities bounce, Jeff Currie of Carlyle on the real cost of the Hormuz shock, and Brad Rogoff of Barclays as Wall Street eyes a Fed rate decision later on this afternoon. We begin this hour with stocks chasing a third day of gains. Priya Misra of JPMorgan writing overall markets are pricing in 2 assumptions. The shock to energy will be short-lived and underlying economic fundamentals are solid. Priya joins us now for more. Priya, good morning.
Morning.
Are those 2 assumptions misplaced?
I think they're a risk. They're both a risk here. We don't know the off-ramp. We don't know the end point. So around the energy price shock, I think that's a big question that the market's hoping that this is short-lived, that the end point is actually, $50, $60 oil prices. And then the underlying fundamentals. I would still highlight, you talked about the last payroll report. That was weak. Now, the previous one was strong. So what I'm hoping to get from Chair Powell is not his view on the off-ramp or the end point, or forecasts around the war or the economy. We really don't know. It's about the reaction function. How is he going to respond to a slow rise in the unemployment rate if inflation remains sticky, which it's been sticky? I think the market's pricing in more of this inflation shock. There's a growth shock that's coming at a time when the consumer is fairly vulnerable and the labor market's very vulnerable. I mean, in terms of hiring, the hiring numbers are weak, and, I'm not really seeing signs of that picking up. So I think that what we're looking for is that reaction function. I think he's going to want to come out of this press conference without any movement. I think the forecasts are not going to move a whole lot either. They have to mark to market the inflation numbers. They probably have to mark to market the growth numbers lower and the labor market, or the unemployment rate slightly higher. So this divided Fed is going to look even more divided because, the dual mandate is sort of pulling them in different directions. So I think he's just going to say data dependent, I think he's going to acknowledge the war, but say that that they sort of remain uncertain.
This isn't Operation Epic Fury, it's Operation Make It Boring for Chairman Powell later this afternoon.
I think so, yes. And I think he's going to be asked about his future. I don't think we're going to get much from that. I think he's going to say the Fed remains singularly focused on their dual mandate. They'll respond as the data comes out. But I think history has suggested, there was an excellent sort of Bernanke paper done in '97 that talked about why do oil price shocks result in recessions? It's because the central banks hike. I don't know if he's going to highlight it. I hear your discussion earlier. I think if he's going to highlight it, inflation expectations might start to rise. But I think if we get a sense from them, what are they looking for? I mean, we know headline inflation is going to be higher. What is the pass-through into core inflation? What's the pass-through into wages, inflation expectations? If he highlights that, that's the reaction function, reading between the lines that I'll be watching for, to get a sense that this Fed is not going to be driven by the Taylor rule. They're going to look at the fact that, what's driving underlying inflation higher. And our sense is underlying inflation. We look at service inflation, look at shelter, look at wages. We're not seeing signs that that is reaccelerating. So I think the Fed should be able to look through it. I don't think we'll get a very clear read from them that they're looking through the oil price shock. But let's see what does he highlight as what the Fed is looking for as they figure out if they can look through this oil price shock.
There's a new Fed chair right now that we're seeing in the market, and it is the 10-year bond yield. And what we're seeing is the 10-year bond yield is saying, ultimately, either way, inflation is going to come lower. And the question is just how much lower in the long term as a result of this oil price shock. You've been talking about how you're starting to find duration somewhat attractive. Do you think that 10-year yields, Fed chair 10-year, is going to ultimately express even lower inflation in the weeks ahead?
So I think the bond market is an extremely important, there's a put from the president, and I think the Fed will look at, so I don't know if it's Fed chair 10-year rate. I like that analogy. I think it's a very important, indicator of financial conditions. To your point on the 10-year, I think the bond market really looked at this and said, this is an inflation shock. The growth shock is sort of missed, I think, because the bond market thinks this is short-lived. I do struggle if it's that short-lived. Is it as much of an inflation shock? So I think the bond market just focused on that spot price of oil. That's going up. That's inflationary. Look at the fact that we're at 3% core PCE, and that's why I think rates rose. In my view, the starting point suggested that people were long duration. Duration's been working as a hedge to risk assets now for the last 6 months. And so I think people were just long. They were long in Europe. They were long in the UK. They were long in the US. They had these relative value trades. I think what we've seen is an unwind of that. The collateral damage of, the VAR shock has been people have sold treasuries. It's also the most liquid asset that you can sell, if you're trying to just raise cash. Now I think value has been created in the bond market where we've priced out a lot of the cuts this year. I do think if the Fed starts to cut later because they're concerned about inflation, they're concerned about that second order pass through into core inflation, they'll have to cut more. The earlier they can start, I think they end up doing less. If they are starting to cut rates later this year to respond to the rise in the unemployment rate, they might be cutting more. So I think, yes, I think the curve is tricky because it depends on when they start to cut rates. But owning the 5-year, that's only pricing in 40 basis points of rate cuts. I think it provides you protection for that growth shock, as well as if we get any sort of credit concerns. That's also lingering AI disruption to the labor market. That's there at the back of our mind. I know we have PTSD from 2022 and we're seeing an oil price shock. But I think if those issues come back to the forefront, I think duration will be your friend.
Is it a time to buy duration, to buy long-term bonds, and to sell riskier credit simply because there's risks that are percolating? We saw yesterday a software company failed to be able to raise money in the debt markets, in the bond and loan markets, because frankly, people just were not interested in them. How much do you see this really starting to break in terms of some sort of credit cycle?
I love that you bring up the credit market because I think that's so important to sort of keep risk assets where they are as well. I think it is going to come down to the balance sheet. I mean, you talk about the software company and then we look at Amazon that was able to issue a large amount at barely any concession. So I think the market is becoming discerning. We're seeing dispersion within the high yield market, within the investment grade market pick up. I think people are looking at the borrower. They're looking at the underwriting standards. They're looking at how liquid, how quickly if I want to get out, will it be easy to get out? At the same time as there are these massive structural changes to business models. So, I think, you talk about riskier credit. Yes, I think risk premiums should be higher, particularly if you're in a business model that might be challenged with AI. You might want to be paid more for it or try and understand who the winners and losers there will be. But for high quality credit, we still see value. In fact, some value has been created there. Those spreads have not widened as much, but look at the balance sheet of a lot of those companies. So we like owning credit and we like owning duration, because what if the economy, the consumer that's been so resilient through high interest rates, now, there's high oil prices. If the consumer starts to break, I think duration will give you that hedge to those, risks. Even if you have less risk, you do have credit risk, as, it's giving you income. I think that's why we're seeing inflows into fixed income, into bond funds. Higher quality credit, I think, where you have good balance sheets and good underwriting, I think there's still value there, but just own that hedge.
Priya, back to the Fed this afternoon. Do you think Powell's actually a lame duck at this meeting?
I don't think so. No, he's still in charge. I think the committee has been rallying behind him.
Do you think it's his second to last meeting?
It is likely. I mean, that's a tough one.
That's what I'm really getting at.
We don't know. I know. I was trying not to answer that question. I mean, let's hope that there is, some resolution with the DOJ, and the fact that, Senator Tillis actually gets a new Fed chair. But I think the committee, there may be dissents. I do think there'll be a few dissents. And it is a divided committee. And I think Chair Powell's done an excellent job of giving the view of the committee, allowing dissents when there's the economic situation right now. I can totally see where the dissents are coming from. I don't think this is a political Fed at all. They're just dealing, like all of us, with lots of unknowns, and they're trying to do the best thing that they can. So, no, I think, and if he's still the Fed chair or not the Fed chair, I think this Fed will continue to just focus on the dual mandate.
Excellent job of not answering the question, Priya. It's good to see you. A professional as always. Priya Misra there of JPMorgan. Nobody knows the answer to that question right now.
Maybe even Jay Powell. Ultimately, we will have to see exactly how these things transpire. We don't even know if we're going to have a replacement to him as Fed chair come later this year. So a lot of questions still.
Things can get messy in a few months' time. Let's give you an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. President Donald Trump is abandoning his efforts to recruit global partners for the war in Iran. The president's criticizing NATO allies for the lack of military support to reopen the Strait of Hormuz. Most countries showed little willingness to join the mission, which military analysts say would be risky without a ceasefire. Meanwhile, Oaktree co-founder Howard Marks saying AI is making the world more unpredictable than ever before. Marks spoke to our own Lisa Abramowicz at the Capital Markets Industry Conference in New York.
Well, I think most people are underestimating the impact of AI. Roughly 18 days ago, on a Friday, that a company called Block, which had 10,000 employees, announced that 4,000 of them were out. 40% of the workforce gone in one day because AI could do the work cheaper and faster.
Marks adding investors are probably better off buying shares of an AI-focused company rather than lending it money. And we are seeing shares of the retailer Macy's up nearly 7% in the pre-market. The department store chain reporting fourth quarter results that beat Wall Street estimates. As for the forecast, its comparable sales and profit came in below expectations, with Macy's saying its guidance is, quote, prudent because of macroeconomic and geopolitical factors. That's your Bloomberg brief. John?
Yahira, thank you. Get set to hear more of that in about a month's time, when a company sees something they don't like.
Yeah.
Geopolitical factors.
100%. And frankly, a lot of people might give them a pass. Although, do they have to offset it with the strength that we saw from Delta and from American in order to get a pass from this market?
Got the weather in January, February. Got the geopolitical factors. Just like all lined up there, ready for a CEO to talk about on the call.
I feel like there should be buttons. Currency differentials, weather, geopolitics.
We didn't execute well this quarter. What have we got? We've got the weather.
It's a menu.
It should be a roulette wheel.
Ulta Beauty?
When the currency's going against them, we've got the currency.
I mean, lip gloss, really?
Right, come on.
Wind.
Right. Up next on the program, claiming the upper hand in Iran.
We did a little excursion, and we're way ahead of schedule. We knocked out their Navy, their Air Force, their anti-aircraft equipment, their radar, and their leaders.
Up next, we'll catch up with Seth Jones of CSIS from New York City this morning. Good morning. It is Fed decision day. That decision later on this afternoon. Heading into that, the scores look like this. Equity futures on the S&P positive by 0.5, on the Nasdaq up by 0.6. Equities doing okay, back-to-back gains and adding to them so far this morning. In the commodity market, Brent and WTI. Brent crude north of 100 once again, 103.65, and up by just 0.2% so far this morning. And the Savannahs this morning claiming the upper hand in Iran.
We did a little excursion, and we're way ahead of schedule, as you probably noticed. And we've had, we knocked out their Navy, their Air Force, their anti-aircraft equipment, their radar, and their leaders. It's been amazing militarily, but it's something that had to be done.
And the hits keep on coming. Here's the latest this morning. Israel claiming the elimination of another top Iranian official. The US ramping up efforts to reopen the Strait of Hormuz, dropping 5,000-pound bunker busters on Iranian missile sites. Bloomberg's Tyler Kendall joins us now for more. Hey, Tyler.
Hey, John. Good morning. Well, there's no sign that there is a let-up in the conflict, as President Trump yesterday confirmed that the U.S. has hit more than 7,000 Iranian military targets. And now this White House is threatening to expand that list of targets to energy infrastructure if disruptions in the Strait of Hormuz continue. President Trump yesterday reiterated his threat that oil depots on Kharg Island could soon be hit after the U.S. went after military targets on the export hub Friday, but spared its energy infrastructure. Just for context here, Kharg Island ships out about 9 of every 10 barrels of Iranian crude, but imagery analyzed by Bloomberg News shows that for the most part, those loadings for the moment have continued unabated. This as President Trump appears to abandon his call for allies to help to secure the Strait of Hormuz after many were weary of his demands to send naval escorts. Now, on Iran's end, we've also seen this escalation as they continue to go after energy infrastructure. Earlier this week, setting ablaze an oil gas field in the UAE and continuing strikes on regional countries, including Saudi Arabia and Kuwait overnight. Plus, we should keep on the radar that Israel is now upping its offensive in Lebanon as it goes after the Iranian-backed Hezbollah militant group. John, amid all of this escalation, President Trump yesterday still maintained that we could see an end to this conflict in what he called the, quote, very near future, but also went on to say that at the moment he's not ready to let up operations quite yet.
Tyler Kendall with the latest outside the White House. Tyler, thank you. Seth Jones of CSIS with this to say, writing, the brutal truth is that while the U.S. military may succeed in degrading Iranian capabilities, it has dug itself a large hole in responding to other global conflicts. Seth joins us now for more. Seth, good morning.
Good morning.
Where and how is this making the U.S. more vulnerable?
Well, I think the reality, as the U.S.'s own national defense strategy and national security strategy note, that the U.S. priorities are elsewhere in the world. China in particular, but also the U.S. notes Latin America. There's an ongoing war in Ukraine with the Russians right now. And the U.S. is already running low. It was already low before this war started on key stockpiles of both offensive long-range munitions, like the JASSM and the Tomahawk, and also on defensive munitions for Patriot and THAAD. So as those stockpiles run low, there's a big question with the Chinese pretty active in the Taiwan Straits and the South China Sea, how much the U.S. is going to have left in its bins for the future.
Lots of reporting, too, as well, that China is keenly focused on this to understand how the U.S. military works. What are they learning from our offensive right now in the Gulf?
Well, I think they are seeing, to be clear, they are seeing a U.S. and an Israeli military that are superb at precision strike. They are also superb at air defense. I mean, we are shooting down a large number of Iranian drones, cruise missiles, ballistic missiles. We're also striking with precision, the leadership, command and control bases. But you also see the limitations of the U.S. military, its stockpiles of munitions. And you also see the asymmetric challenges that the U.S. faced in Iraq and Afghanistan. We're seeing now in the Strait of Hormuz, which is the threat of mines. It's not a big conventional force that the Iranians have, but it's those asymmetric challenges that do pose a threat.
You touched on it when you're talking about the Chinese vessels that are in the Taiwan Strait. Would this be an opportune time for Xi Jinping to do something when it comes to Taiwan? I
mean, it's possible. I mean, anything's possible. The big challenge for the Chinese at this very moment is they have obliterated their leadership. Within the last 2 to 3 years, they've gotten rid of over 100 senior PLA, People's Liberation Army officials, including of their top committee, the CMC. So the Chinese are not really in a position from all levels, the strategic down to the tactical level, operators, to make a move at this point. But we do see them. I was up in an aircraft, U.S. Navy P-8 in the South China Sea last year. The Chinese are everywhere. They are conducting exercises on a regular basis around the Taiwan Strait to simulate a blockade. So they're certainly thinking about it. That I don't think now is the ideal time for them just because of what they've done.
There's a question about just the munitions and what type of resources the United States has. There's also a question of alliances and where they lie. How do you see them really shifting in the wake of and perhaps accelerated by this war in Iran?
So, I mean, on the alliance structure, I've talked to a couple of senior European defense officials, including Minister of Defense the other day of one of the U.S.'s NATO allies. I think the challenge there, they were never briefed on this war to begin with. They were asked, once the U.S. struggled along those lines, to come in. The same was true with U.S. allies in Japan, South Korea, Australia, all of which have been hesitant to jump into the war that the U.S. and Israel started. So I think the U.S. position with some of these allies has been very transactional recently, and I think at some point there has to be an effort to bring them more closely together. But they are very concerned, the ones in Asia, about the growth of the Chinese, and the ones in Europe very concerned about the Russian military.
Seth, just to finish on China, have we, the US, learned anything about Chinese capabilities in places like Iran, in places like Venezuela, and deficiencies specifically?
I mean, on the Chinese side, the reality is the Chinese have not fought a war since the 1970s, and they weren't particularly effective. But what they have done is they've provided components to the Russians in the war in Ukraine. They've also provided components and various types of assistance, including intelligence, to the Iranians, not just now, but over the last several years, including to some of Iran's partner forces, including the Houthis in Yemen. So they've also put contractors and intelligence officials on the ground to learn how to conduct these kinds of wars. So they are taking notes.
How flawed is that experience, though, given how clean the operation was in a place like Venezuela? We've heard all things like they've got the defense systems that were sold to them by the Chinese, and ultimately none of it stood up against U.S. capability.
Yeah, I mean, it really shows in some ways, actually, and I know there have been some comments last year about the expense of, say, the F-35 stealth aircraft, which is in the billions of dollars. But the benefit of a fifth-generation stealth aircraft that Lockheed Martin makes is that it's hard for radar to see it. So one of the things I think that even those Chinese and Russian air defense systems are finding out is that a fifth generation, and the U.S. is now working on a sixth generation aircraft, they are tough to see.
Seth, it's good to see you. Thanks for breaking it down. Some real knowledge there. Seth Jones there of CSIS on the ground operation that we're seeing turn out day after day.
And when it comes to those stealth fighter jets, there are reports that they're actually flying very close or even in Iranian airspace right now, and there's really nothing the regime can do.
Up next on the programme, we'll catch up with Jeff Currie of Carlyle on the forces reshaping the energy market. Plus, Yahara has some morning movers. AI optimism pushing memory stocks even higher. That rally makes a comeback. From New York, you're watching Bloomberg TV. Stocks just retreating from session highs, still positive, but pulling back just a little bit in the last few minutes. We're positive by 0.25% on the S&P, on the Nasdaq, up by 0.4. This crossing just moments ago from Iranian state TV that part of the South Pars gas field has been attacked. This is from Iranian state TV. Part of the South Pars gas field has been attacked. If you're not familiar with that, it's a very large gas field offshore in the Persian Gulf, and a notable strike, if that's the case. That headline crossing just moments ago.
So a lot of questions about this strike. Has this come from the United States? Has this come from Israel? But as you mentioned, in terms of energy production, this is a massive offshore natural gas field. So there's going to be a lot of questions right now, and individuals, and you can already see gas futures in Europe spiking on the news. There's going to be a lot of individuals that will want to know exactly the damage that was done to this offshore field.
And who did the damage? Because initially, so far, there's been limited damage to infrastructure in the Middle East, to energy infrastructure specifically, damaged by the US or by Israel. There have been some exceptions, but limited so far. That would be a severe escalation if that was intentional and from their side.
And particularly for this gas field, given the fact that it's shared between Iran and Qatar accounts for about a quarter or more than that of the world's liquefied natural gas. It's the reason why there is a response in European markets. If that becomes fair game, how much of the world's supplies are suddenly put in the firing line?
We'll keep tracking that headline for you. It comes from state TV. Iran saying that part of the South Pars gas field has been attacked. Economies pulling back just a little bit on the S&P 500. Let's get you some single names. A few hours away from the opening bell. Yahira has more. Hey, Yahira.
Hi, John. Earnings are in for Macy's, and it was a bit of a mixed report, but as you can see, investors choosing to focus on the good with shares up 8.7% in the pre-market. It was a beat on comparable sales and profit in the last quarter, but Macy's struck a cautious tone when it came to the guidance, calling its outlook prudent, citing both macro and geopolitical risks to spending. Meanwhile, we are seeing Applied Optoelectronics, Lumentum Holdings all soaring in the pre-market, saying demand momentum is growing at an industry conference. But if you're wondering what these companies do, well, they make the components that move data between AI servers, and they've been on a bit of a wild ride recently. That's because NVIDIA CEO Jensen Huang at the GTC conference made some comments on optical connections, saying that it won't go all in on that. Instead, it will continue to also use copper. So that just raising questions over how much demand can really scale. But these companies having a good day this morning. And we end on shares of microchip stocks. These are the best performing stocks this year. Micron up 2% in the pre-market as they ride a wave of surging demand for their memory chip products. But now comes the real test with Micron reporting after the bell. And with that stock up nearly 60% year to date, it will be all about whether it can deliver. John?
Yahira, thank you. Thanks for the update. More from Yahira later this hour. On our radar this morning, Iran launching more missile attacks overnight, targeting the UAE, Saudi Arabia, Kuwait and Tel Aviv. Tehran vowing revenge following the assassination of their security chief. Elsewhere, the Pentagon planning to mass-produce one-way Lucas attack drones. The drones were created by reverse engineering Iran's cheap and deadly Shahed system and are being used in the war in the Middle East. And finally, Japanese Prime Minister Takaichi saying she's facing a, quote, extremely difficult summit with President Trump tomorrow. The statement coming after Tokyo's refusal to send warships to Hormuz. Takaichi citing Japan's pacifist constitution.
Yeah, and part of the issue that Takaichi is presenting is the lack of capabilities that they have to really support U.S. troops, which is something that NATO allies have highlighted as well. She said, I intend to convey these points clearly, and I'm sure the U.S. side understands these laws in terms of the pacifist laws. Given our history, either way, it highlights how difficult it is for international leaders to come to the White House and have any kind of discussion with President Trump, given some of the domestic pressure that they are all facing.
Two things I imagine the White House is going to bring up. After World War II, and obviously Japan has this pacifist regime in place, they did send minesweepers to the Middle East after Operation Desert Storm. And in 1991, when the U.S. wrapped up the Gulf War. That's the first point I think the White House will say. Well, can't you just send a minesweeper? The second point, I imagine this president, because he's insinuated in the last few days, is going to go through all the countries that refuse to help the United States right now. How many U.S. men and women are stationed in those countries right now as a force of deterrence? Japan has some 55,000 and counting U.S. service members, and I imagine that's going to come up in the meeting.
And they are very exposed to what's happening in the Middle East, given how exposed they are on the energy side. Jeff Currie of Carlyle writing this: the cost of rebuilding and recovering from the Hormuz shock will be enormous and underscores the regime change towards physical assets. Jeff joins us now for more. Jeff, welcome to the programme. It's always good to catch up with you, sir. Fluid environment, so allow me to go through the headline of the last 5 or 10 minutes or so. One headline, one report coming from Iran that their energy assets have been struck. Now, I have limited information beyond that, but Jeff, from your standpoint, in the week since we last spoke, has this got worse or better?
Worse. I like to call it molecular contagion. You know, last week we were talking about shortages in Singapore. You know, prices of jet fuel spiked to $230 a barrel. This week, you know, it's in Rotterdam. Rotterdam's $220 a barrel. Thailand, Philippines, New Zealand, Australia. So this thing's going intercontinental. And, you know, so you look at Singapore, Rotterdam, the spread, there's no more price spread, there's no more spare barrels, there's no policy fix, and it's just physics at this point. And I want to emphasize these are physical supply chains. And that the idea of around financialization and the ability to print money doesn't apply here. And I think the title of that piece says it all. You can't print molecules.
Jeff, with that in mind, where and how do you think we're underpricing this risk still in financial markets?
That's the peculiar thing about this, is that you look at the paper markets, they've entirely disconnected from the physical markets. Crude oil on an Oman basis, on the other side of the strait, the side that's free, spiked to $173 a barrel yesterday. Crude delivered in Asia is a blend of Dubai and Oman, which is trading somewhere around 130 and 170. And today, this morning, they're call it 120 to 150. So you're delivering crude into Asia at somewhere around $130 a barrel. Product prices are spiraling above $200 a barrel. So the disconnect is between the paper market, which is sitting around 100, and the physical market, which is showing a very different environment.
Jeff, some people have speculated that's because of certain types of manipulation in the futures market, and that's the reason why you have seen this gap blow out. Do you think there's credence to that?
You could argue that Monday last week, there was a mysterious 11 million barrel seller. I don't want to get into that. It's not enough to really change the dynamic. I think that the bigger factor that was likely driving WTI and Brent and staying lower is the price of Urals, Russian crude oil. It's rallied $65, $70 a barrel once they took off the sanctions. So WTI and Brent were the high-cost barrels. The Russian was the cheap. What happened? You closed that gap. And now that you've closed that gap, you don't have any more spare barrels in the system, and this rest of the complex likely to start to rally. I go back to the point that John started with is, we're dealing with an enormous supply shock. By the way, the supply shock is almost equal to the demand shock during COVID. And we know what that did to global supply chains. So I think at $100 a barrel, this thing's mispriced, even against the physical market.
There is a sense, though, that this time is a bit different than, say, the 1970s in terms of the world's reliance on oil, especially China, how much they've diversified to electric vehicles, to nuclear energy, and other places as well. How much do you think that that is going to be the growing trend, to diversify the sources of energy in myriad ways beyond what we were doing, even during the so-called Green Revolution, as people try to avoid these types of shocks?
Well, I absolutely argue that the renewables, nuclear power, are born out of the 1973 energy crisis, and this is going to unleash an enormous amount of investment into renewables, nuclear power, and other localized energy sources. The problem, though, is we call this the new dual order. The problem is that we haven't got to that transition where we have electrified everything, localized it. And the type of oil consumption that's left in the global economy is critical. And so if you pull those barrels out of the system, the rippling effect or the cascading effect through global supply chains is going to be significant. You go from gas to urea, urea to fertilizers, fertilizers to the dinner table. Or you go from LPGs to synthetic fibers to cotton. You switch out of soybeans and corn into cotton. By the way, I think the best sector to try to get value in right now would be agriculture because it hasn't priced it in.
Jeff, when it comes to barrels coming off the market, this came from an industry consultant in terms of China. They're looking at potentially a drawdown in commercial and operational stockpiles amounting to as much as 1 million barrels a day. That can happen over the next 4 to 6 weeks. What would that mean for the price of crude?
I think the key point is once you exhaust those inventories, there's nothing left. Think about it this way. You have demand up here, supply down here. Once those inventories are exhausted, boom, you have to bring demand down in line with supply. And to do that, you're going to need prices far higher than where we are right now. I like to do the mirror image of COVID. Let's go back to COVID. It was the exact opposite. You had a situation which you had demand up here and, or excuse the other way, you had supply up here and demand down here. And so what happened? The demand collapsed. Eventually, you filled all the inventory capacity in the world, and you had to bring supply down in demand immediately. What did that require? A minus $37 a barrel price to create that rebalancing of supply and demand. Now we have the exact opposite environment. So just imagine what it's going to do to require that reduction in demand to bring it in line with supply if it took a minus $37 price to create that rebalancing back in 2020.
So, Jeff, I'm going to ask you the question. What would it take? What's the opposite?
I'm going to stick to the same answer I gave you last week. You get long, buckle your seatbelt, and hang on for the ride. We'll know when we start to get to that point where the system starts rebalancing. But I want to emphasize, don't underestimate the type of volatility. If you take European gas in 2022, we saw Russia cut it. And by the way, the market ignored it in June of 2022. By August and September, you were at $400 a barrel. Do you know where prices were in December of that year after you destroyed so much demand? They went negative. So I'm not going to say oil's going negative, but what I'm trying to tell you is it's going to be a really bumpy ride. You've seen no evidence of demand destruction that rebalanced this market yet. So we haven't even really started the rebalancing process yet. So the upside here, I would argue, is substantial. Again, we want to be long. And I look at the market. It's shorting energy stocks and getting long everything else that is short energy. I think you're picking up pennies in front of the steamroller right now.
Jeff, we buckled up. That's why we have you on again this week. Can you give us a range of how high, though, prices could go? I know you don't want to give us an exact definition of where you think Brent oil is going to hit, but give us a range of when you say get long. I mean, how long are we talking?
But look at Oman's already traded at $173 a barrel. Jet fuel in Rotterdam is $220 a barrel. In Singapore, it was $230 a barrel. And we haven't started the rebalancing process. All we have seen is what happened in places like Thailand and China hit export bans that then create ripple-on effects and shortages. Then you have the hoarding that begins to take place. You're $8 a gallon gasoline in Los Angeles right now. So, the upside here, again, I don't want to speculate on how high, but you've already witnessed something like 173 in the physical market. So that's my point here. There's a massive disconnect between the physical world and the paper world, and the paper world includes the financial world. I like to point out it was in January of 2020 when COVID hit. I remember I was looking at the what was going on in China. It was the second largest economy in the world just shut down. Stock market rallies, oil is hanging in there, not selling off. And I'm going, guys, we got to get short this thing. You can't hit the global economy with a shock of that magnitude and not expect bad things to happen. And we have the exact mirror image of the same similar size shock hitting the world right now. And the market on the paper and financial side is not keen off the signals that it's providing at this point in time.
So, Jeff, at some point it gets real for the market. And with COVID, it was when the northern Italian cities started to shut down. There was a sense that this was getting real, that it was spreading beyond China, it was hitting Europe and could hit the US as well. What makes this get real? What closes the gap between physical and paper markets?
I think it has to be visual images of real shortages in the United States and in Europe. Now, the U.S. will be hard, particularly if they do export controls on that. Europe will likely be the first one to hit. And I think the implication here is the U.S. believes it's safe because of energy dominance. And this is the point I made it last week. From an equity market perspective, that equity market in the United States is a global market. All of those Mag 7 companies earn their earnings in Europe and Asia and all over the world. So when this energy crisis begins to hit places like Europe, it's going to impact the earnings of those companies that sit inside the U.S. because the U.S. equity market is not a U.S. domestic market. It's global, so it'll feel the impact. And I think that if the Americans are going to feel it first on the wealth impact before they'll ever feel it in the at the income cash flow level. The Europeans, unfortunately, they're likely to feel it at both sides relatively soon.
Jeff, it's good to see you. Thanks for making time for us again. We'll catch up soon, no doubt. Jeff Currie there of Carlyle. A few headlines there, of course. One, you cannot print barrels. And two, even at 100, this is not pricing the shock that he sees playing out.
Yeah, he sees it in the physical market, and he says that it's only going to get worse until you get lines lining up to get energy. That's going to be a problem. He also said something about agriculture. And I think that we cannot overlook this. The idea that 40 to 50% of the world's urea, which is a key ingredient in fertilizer, is being withdrawn from the market right at the same time that you would have a planting season is a reason why I think a lot of people are watching with concern the world's food supplies.
Jeff Currie is a breath of fresh air for the people who continuously message me, and that is why I bring up Oman and Dubai grades, because they are $50, $60, $70 north of where the financial markets is pricing in Brent crude. That is this massive gap. Second point, he mentioned unless the U.S. does export controls. That is something, and I don't know what level it is on the
coming up, doesn't it?
I don't know what level it is right now on the menu for this White House, but it's certainly on the menu.
Let's get you an update on news elsewhere this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. A top U.S. counterterrorism official resigning over the war in Iran. Joe Kent saying he, quote, cannot in good conscience back the Trump administration's war. In his resignation letter, Kent writing, Iran posed no imminent threat to our nation, and it is clear that we started this war due to pressure from Israel and its powerful American lobby. Meanwhile, NVIDIA CEO Jensen Huang says the company is firing up H200 chip production for customers in China. The chip maker has been working to reestablish sales of its AI processors in Beijing after the market was virtually closed by U.S. export restrictions. NVIDIA continuing to hold off on including any China data center revenue in its financial forecasts. And Arizona is filing criminal charges against Kalshi, accusing the prediction market exchange of operating an illegal gambling business. Kalshi is already facing legal challenges in about a dozen states, but Arizona is taking a step further, becoming the first to file criminal charges. A spokesperson for Kalshi telling us here at Bloomberg the company is subject to federal jurisdiction. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara in the next hour. Up next on the program, waiting for the data.
The Fed is going to be on pause. They do not want to preemptively react to either inflation moving up or growth moving lower. And with policy being close to neutral, they feel like they're well positioned to essentially wait and see the data.
Up next, Brad Rogoff of Barclays from New York. You're watching Bloomberg TV. Live from New York, welcome to the program. Equities just about positive on the S&P 500, up by 0.3. On the S&P, on the Nasdaq, up by 0.5. Earlier on this morning, about 30 minutes ago, we got this from Iranian state TV that the South Pass gas field has been attacked. That's an offshore gas field in the Persian Gulf. It's the only headline we've really got to go on at the moment. Off the back of that, you did see a move in gas prices, gas futures picking up just a touch.
So it's a field they share with Qatar. It's a massive field. And if this attack is confirmed, would mark the first time Iran's upstream oil and gas facilities have been targeted in the war, which is why you're going to see a little bit more risk premium moved into not just gas futures, but also potentially as well Brent oil.
We'll stay on top of that story for you throughout this morning. Heading into this a little bit later, the Federal Reserve meeting under surveillance this morning, waiting for the data.
The Fed is going to be on pause. Why? Because they do not like this type of stagflationary environment, and they do not want to preemptively react to either inflation moving up or growth moving lower. And with policy being close to neutral, they feel like they're well positioned to essentially wait and see the data. They're going to be very data reactive, and they're going to wait out to see how this plays out.
So here's the latest this morning. A Fed rate decision due at 2 p.m. Eastern Time. Traders expecting the central bank to leave rates unchanged as policymakers weigh the economic impact of the Iran war. Brad Rogoff of Barclays writing the market now expects no Fed cuts in 26. We continue to expect 2. Brad joins us now for more. Brad, good morning.
How you doing?
Good to see you, sir. So let's go through the expectations. Markets at none, Fed's at 1, you're at 2. How do you get to 2?
Well, we're at 2 if you move into early next year, really, as well, right?
Okay.
One this year. We changed that call at the end of last year, end of last week. So we moved back from June to September in terms of the first cut, and then we went into early next year for the second. You know, how do we get there? I mean, look. Obviously, there's a lot going on, as you guys have just been alluding to, over in the Middle East, and the Fed's got to weigh both of those things, right? The inflationary impact and the market, and certainly the rates market so far is definitely weighing the inflationary impact much more than the growth impact. And, you know, if this comes to a close in some way in the short term, then the growth impact, you know, probably is not as large. But if we see the oil prices that you guys were just talking about with someone, that's going to have an impact on the consumer. There is going to be concern about growth. We're also probably going to have a new Fed chair. We're going to have a little different complexion of the board. We think that could get you there by September, not June, which we had been thinking.
Let's get to all first. So Jeff Currie of Carlisle comes on. He's talking up much higher prices. He's uncomfortable with how this market is pricing this story. Are you more comfortable?
I wasn't thinking some of the numbers that he put out there, but we had been saying as soon as there was activity that the market felt too low to us. We're getting closer to levels that do make sense. Look, I think if we're talking about the U.S. economy, I think there was also a good point made whereby I don't know if we'll go to export controls, right? But we are an energy superpower, right? We produce plenty of oil here, and the U.S. does have better flexibility. It should lead to the U.S. holding up better from an economic standpoint relative to a lot of other places in the world.
Does it make you nervous that there isn't fear right now, really, in markets? The capital markets are still completely open. Companies can sell debt for the most part unless their industry is challenged. And everyone's looking to buy the dip, not exactly get out screaming.
Well, that's been the right trade for a while now, Lisa, right? So I didn't answer the question if it makes me nervous. It does make me a little bit nervous, right? But I also understand that. And look, we're still in, you look at credit spreads, right, to your point, we're still in the bottom quartile, right, that we've been in historically. But investment grade spreads backing up from what were historic tights by 20 basis points, that's a pretty big move when you're starting in the 70s, right? And so there's something coming through markets. Credit markets have actually underperformed their normal beta versus equities. So we're probably supposed to look a little bit towards equities if we worry about more of our concern there.
Well, Howard Marks yesterday was talking about how essentially he wouldn't be a buyer of 100-year debt from Google because he doesn't understand why you would want to be a fixed income investor in some of these tech names when there's limited upside and a lot of downside given some of the changes ahead. Are you seeing any pushback in financing the capital plans of some of these hyperscalers, which is the benchmark for why people are so confident about the U.S. economy?
Yeah, look, I think you could say that about 100-year bonds of probably any company, if we're being honest. But to answer your question, pushback a little bit in the sense of the new issue concession that people are demanding in IG credit markets where a lot of this hyperscaler financing is occurring. It's definitely larger than we've seen. But can you still get huge deals done like we just saw Amazon get done? We had, record issuance week in high grade last week. So, yes, some pushback in that people are demanding a little bit more spread, a little bit more yield for it, but you can still get it done.
Brad, it's good to see you. Thanks for being here. Brad Rogoff there of Barclays. Capital markets still open.
Very much so, except for a couple companies. And there was this one company, a software company, that focuses on making online polls, and it was not able to raise more than $5 billion in the loan and bond market.
Focused on all the wrong things right now.
Well, I mean, arguably, some of the online polls that you get, how do you feel about this cloud? You are an introvert. It's a question of whether, potentially Claude could do that too.
Is that what they do? Do you play those games? It's not what you do.
I don't want to talk about it, John.
All right. Just,
I'm introverted.
You spend some time on that.
I spend lots of time. That's how I prep for this show.
What do you see? Pictures and stuff like that?
I see my mom.
We should talk about this.
Let's not. Let's move on.
Coming up on the programme, Tchir of Economies Securities, Steve Richardson of Evercore, Bhave of Bank of America, and Kelly Kowalski of MassMutual. The third hour up next.
There's downside risk around labor, but then you also have to acknowledge that there's some upside price risk.
This oil price shock is another headwind to the labor market expansion.
The Fed will have to increasingly acknowledge the two-sided risks from this.
For now, the Fed is going to be cautious.
The Fed is going to be on pause. They do not want to preemptively react.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P elevated following back-to-back gains on the benchmark. We're higher by another 0.25% on the S&P 500. In the commodity market, check out Brent, still north of 100, holding on to triple digits, 104.30, up by 0.8%, heading into the big event later on this afternoon. Operation Make It Very Boring for Chairman Powell in that news conference at 2:30 Eastern Time.
It's going to be difficult for him to make it boring, and not just because we're hosting the Fed Decide starting at 1:30, tune in, but also because they have to come out with their statement of economic projections. And regardless of how much credibility you can put into that, given the fact that we're all just throwing darts at a dartboard, people are going to take that as signal. What is their reaction function collectively to the idea of an oil price shock? Is it to prolong keeping rates where they are, or is it potentially keeping an open mind even to whether it's a rate hike or a rate cut going forward?
Needless to say, it's a super fluid situation on the ground in the Middle East right now. Moments ago, a headline crossing about damage being done to energy assets in the region. That reporting coming out of Iran, and we're looking for further verification from elsewhere.
Right. We want to know exactly what kind of strike this was, the damage on this facility. One is the South Pars natural gas field that they share. This is a huge facility that they share with Qatar. Another is a nearby oil and petrochemical facility. So this would mark the first time that Iran, in terms of upstream oil and gas facilities, have actually been targeted. The question is, who is targeting this energy infrastructure. The president has notably a number of times talked about the fact they went after military installations and facilities on Karg Island, but didn't touch the energy infrastructure. So that's a big question this morning.
This statement from the president as we speak just moments ago. Remember, for all those absolute fools out there, Iran is considered by everyone to be the #1 state sponsor of terror. We are rapidly putting them out of business.
Two things can be true at the same time. The Iranian regime has been reaping terror, frankly, across the region, and a lot of the people who are being targeted have been the leaders of direct oppression on a lot of people, rank and file citizens of Iran. That said, there is a bigger question about the goals of this conflict as well as the duration of it. Those two things are coming into conflict at the same time. So regardless of what the regime did or who it represented, a question of what this war accomplishes and what this administration would like to see out of it. Those two things are what people are trying to grapple with.
Off the back of these headlines, gas prices bouncing just a touch, crude holding on to gains, Brent at 104. Earlier on, Jeff Currie of Carlisle, about 30 minutes ago, making the case that even at 100, this is not pricing in the risk he sees developing in the Middle East.
You cannot print molecules. He thinks this is an entire regime shift for the energy complex and that the paper market, what is going on in terms of what you see on your Bloomberg terminal across the screen, is not really what is happening when it comes to the physical barrels on the market. And he looks to places like the Oman and Dubai grades, and they are north of $50 to $70 a barrel than you're actually seeing in futures. And that's what Asian countries are taking on right now, which why he says this has a lot more to go in terms of how high prices can get.
Equities struggling to hold on to gains, positive here by about 0.2% on the S&P. Coming up this hour, we'll catch up with Peter Tchir of Academy as stocks record back-to-back gains. Aditya Bhave of Bank of America reacting to the latest inflation data, and Kelly Kowalski of MassMutual counting down to today's Fed decision. We'll begin this hour with stocks higher as President Trump reiterates the conflict with Iran will end soon. Peter Tchir of Academy writing the following: increasingly, the patience with waiting seems to be dissipating as the markets are looking for results. Pete joins us now for more. Pete, good morning.
Morning.
You are uniquely positioned as a firm to talk about this. We often say this, stacked with military experience over at Academy. Can we talk about the facts on the ground at the moment? Do you see the US and Israel making progress? Are we making progress?
Yeah, I think we're making progress. We went through a list of all the things that we want to attack and bomb, and we've been going through those, I think, successfully. Now, I think when we look at the Strait in particular, the big difference there is when we're talking about this at Academy with a lot of our generals and admirals is when Iran is firing missiles at Israel, various places, right? They travel for a long distance. There's half an hour, there's an hour, there's time to scramble. The Strait of Hormuz is 21 miles at its widest, right? So there's the ability, if they are launching from close to shore, there's only minutes before that drone hits. And so I think that's the next wave of this is kind of eradicating their ability to target ships from close to the coast. But that is going to be very difficult. General Bellin, she said one thing. This was more about the Houthis. It's kind of rude, but I think it's very true. She was talking about them. It's hard to bomb someone in the Stone Age when they already live in the Stone Age. So these are people who are prepared for this sort of fighting, shoot, hide. So that's where it gets difficult. And I think that's why this is dragging on.
We're conditioned to buy in the equity market. We being investors, Wall Street, market participants, conditioned to buy an equity market whenever it dips. We've seen that repeatedly, largely because when things get tough, there is a belief the president backs off and changes his approach to things. Does he hold the keys to the outcome of this?
You know, it does seem like we are winning, but to me, there's this race, right? It's us winning, trying to make progress towards some sort of regime change. At the same time, Iran's ability to keep oil prices higher. And to be honest, oil is probably the third or fourth most important thing that we talk about lately. We're much more focused, I think, on liquid natural gas. LNG is a problem. And I think when we look at this, the U.S. is somewhat, comforted because we have our own supply. China has their stockpiles. I think this is becoming very important within a week for Asia ex-China. You're starting to see, I love going on to NIChem and searching force majeure. It's like kind of a cool word, but it's dangerous, right? And you're seeing more and more force majeure. And again, one of our other generals who spent a lot of time actually ran BP Anglo South American oil business. He's reminding our clients, when you turn these sorts of facilities off, it's a 1 to 3 week startup process again. So this is starting to me, I think if we're still talking about this next week, Asia is in trouble.
This headline from Axios crossing just seconds ago, getting some further details on what's happening here. They're reporting that Israel struck the largest gas processing facility in Iran. Looking for further details, the Israeli strike was carried out with approval of the United States. That's coming from Axios just moments ago.
So the second part of that headline is, I think, what I find a little bit confusing, because this administration definitely does not want to see an energy shock, definitely wants to try to make sure that consumers aren't the ones vulnerable for what Trump would call an excursion, this war in the Middle East. So it would be interesting if the White House gave it a basically green flag to strike a huge gas processing facility within Iran.
Reporting from Axios, Pete, from a senior Israeli official, the Israeli Air Force struck the largest natural gas processing facility in Iran, located in the southwest of the country. The strike was carried out in coordination and with the approval of the United States.
So when we've been kind of wargaming and playing this out internally, I think that Trump obviously likes maximum leverage, right? And the problem I think we're running into right now is maximum leverage requires, hitting their oil fields, hitting that, whether it's on Carg Island or elsewhere, and kind of reducing their ability to generate income. The flip side of that is everything that we do that puts maximum pressure on them probably puts maximum pressure on us in terms of disrupting oil. So I think this is a real delicate, balance. I don't know which way it swings out in the end.
At the same time, people are saying the U.S. is less sensitive to higher oil prices, and ultimately this is a problem for Europe, not necessarily the United States. Increasingly, the U.S. and assets here are considered havens once again. How far does that go? I mean, do you think that the market is being overly complacent about how much the U.S. economy could get hit?
Yeah, so one thing I do want to say is I think we should maybe temporarily suspend the Jones Act, and that's the act that forces U.S. ships to go from U.S. ports. And that's one reason we ship a lot of gasoline out of the south and we import a lot into the north. So I think we could do some things like that. Having said that, I think this is really coming down to the supply chain. It's going to be fertilizer. It's going to be plastics, the phenes, the polyethylene, benzene, right? As you start seeing those slow down, especially in China or Asia, it becomes our problem, right? What happens when someone who's trying to make a phone, for example, in India, can't make it because some components not being produced in India because of the plastic? So global supply chains, I think that's one thing we learned so much from COVID, right? They're very intricate, they're very fragile in many ways. And I always go back to what the CEO of Whirlpool said. A washing machine that's 99% done is not done. And I think that's the growing risk here, is little disruption to the supply chain that no one would think about, and all of a sudden we have problems down the road. I think we're not there yet. But again, I'm increasingly nervous the market's not pricing this in. In a week, we're going to get this, ooh, shoot, we are in deep trouble and we're 5% down.
Well, so listening to Jeff Currie and listening to yourself, I'm ready to sell everything and go to cash and ultimately hide in bed. And at the same time, Delta and American Airlines come out and they talk about how consumers are spending so much that it offsets the losses that are felt in higher costs from some of these supply chain disruptions. How far do these disruptions have to go before the momentum in the U.S. consumer isn't enough anymore to stave off a true downturn?
So I think on this side of the equation, it has to start disrupting our actually good supply chain. So you have to actually see final goods having problems. So it's not just the oil and gasoline, it's going to be plastics. It's going to be shortages of something where people are like, ooh, wow, so-and-so's not going to make their quarter because they're not getting their goods finished. Again, we're not seeing that yet. I think that comes down the road. The flip side of this is what's happening in jobs, right? Because of this attack, no one's talking about the worst job report we've had in a long time, NFP, right? So there's weakness there. You're seeing, I think, a credit pullback. And I'm fairly comfortable where credit spreads are right now, but I think credit's getting tighter, right? Credit is an integral part of keeping this economy rolling. So if you start seeing companies not get access to credit, you got to slow down there. I think individuals, we're seeing some of that again as well, where we've been talking about this for a little while, but the working poor, there seems to be an increasing number of people who have jobs and are still struggling to make ends meet. And that's a very unique situation. We've never really had a recession kind of caused by that. So I think these things are all adding together. And if I'm the Fed, I'm going to try and be more dovish. I don't think they will be, but I think there's risks from all sorts of things that are hitting us right now.
Peter, you mentioned the Jones Act. That waiver is the first lever for the administration to pull, and we have reporting that that's coming within days. What else do you think they're going to do? Because I keep hearing that there, minimum, is a discussion about an export ban when it comes to U.S. fossils and fuel products to the rest of the world.
Well, to some extent, I think you almost need the Jones Act to be repealed temporarily to do that, right? Because otherwise you can't take the oil and gasoline that we have sitting in the southern ports and bring them to the Northeast. So I think that's a step in that. Yeah, I think this is, again, I'm going to go back to what we've been discussing now for a year. I try and mention every second time I'm on. PROSEC, or Production for Security. This has just been a giant wake-up call that everyone has to produce more of their own stuff. And I think anything that's integral, if it's electricity production right now is one of the most important things, probably always has been. Every country has to be re-looking at where they're generating their electricity, how they're doing it, and making sure they're less dependent. Again, I think the president was in Scotland the other day. I don't always agree with everything the president says, but he kind of gave them a lot of grief for not using their own oil in the North Sea. Like, yeah, why aren't you doing that?
Pete, what happens to states like California that are highly dependent on Asian imports?
I think this is, again, you're going to see even within the U.S., some states do much better than others. Again, those who are adopting this, those who are really willing to make this smelting, refining, they're going to see the shift, right? And they're going to pay a price for that. So again, I think everything has a cost right now, and regulatory environments went one way, and now you're seeing kind of the problems that are caused by these bottlenecks.
Pete, it's always good to see you. Thanks for dropping by. Peter Tchir there of Economies. This from Axios just moments ago, just to recap the news for you, from a senior Israeli official. They're reporting the Israeli Air Force struck the largest natural gas processing facility in Iran, located in the southwest of the country. The strike carried out in coordination with and with the approval of the United States. Now, limited information from the US and Israeli side on the record at this point. I think we need that additional clarity to figure out whether we just opened up a new front in this war.
And also, if that means a new front is opened up, what comes next? Does this mean the president is willing to go on Karg Island and really take over the energy facilities there, which means the regime is completely cut off for the lifeblood of their economy?
Makes you wonder where this is going next, Bramo.
Yeah, and whether they're going after the cash flow into Iran. This particular facility is really key and critical to Iran's gas exports. It also provides a lot of the domestic gas usage. So a question of winning the hearts and minds of Iranians, as well as attacking some of the financial resources of the Iranian leadership.
Futures struggling to hold on to gains here in the equity market, just about unchanged on the S&P 500, with an update on stories elsewhere this morning, including an update on that. Your Bloomberg Brief with Yahara. Hey, Yahara.
Exactly, John. Israel striking the largest gas processing facility in Iran. Axios reporting Israel carried out the attack in the southwest of the country with the approval of the U.S. It marks the first time Iran's upstream oil and gas facilities have been targeted so far in the war. Meanwhile, President Trump confirming his planned summit with Chinese leader Xi Jinping has been postponed as the Iran war stretches on. Trump saying his visit to Beijing should happen in about 5 weeks without specifying an exact date. The president going on to say he believes the U.S.-China relationship remains in good standing. And in sports, Venezuela is the winner of the 2026 World Baseball Classic after a 3-2 win over Team USA. It marks Venezuela's first ever tournament championship, and for Team USA, it's the second straight runner-up finish. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later this hour. Up next on the programme, the morning calls. Plus, we'll catch up with Steve Richardson of Evercore, with US oil majors hovering near record highs. That conversation up next, live from New York City this morning. Good morning.
We're dealing with an enormous supply shock. So I think you're at $100 a barrel. This thing's mispriced. Get long, buckle your seatbelt, and hang on for the ride. We'll know when we start to get to that point where the system starts rebalancing. But I want to emphasize, don't underestimate the type of volatility. It's going to be a really bumpy ride.
It's a roller coaster I don't want to get on. With Jeff Currie of Carlyle on the programme a little bit earlier. The president just moments ago on social media asking when too late Jay Powell's going to cut interest rates. Based on the headlines coming out of the Middle East, not anytime soon. This is the latest from Axios. They're reporting the following. If you're just tuning in, welcome to the programme. An important development in the last 40 minutes or so. According to a senior Israeli official from Axios, the Israeli Air Force struck the largest natural gas processing facility in Iran, located in the southwest of the country. The strike was carried out in coordination with and with the approval of the United States. As we get more information on those strikes, equities just pulling back from session highs and now just about unchanged on the S&P 500. Likewise on the NASDAQ, turning lower on the Russell. In the commodity market, Brent crude elevated, reclaiming 105, Lisa, on Brent this morning.
Yeah, a real question here about Brent, about WTI, but also liquefied natural gas. And over in Europe, you are seeing those futures rise on this, as this was the biggest exporter of Iranian natural gas. It did share this field with Qatar. And it goes to the question of at what point do you get something more than just storage facilities that are too full, storage facility, the actual production lines that have to be restarted, but then the extra layer of production facilities destroyed, production facilities rendered not in use anymore. And that, I think, is what's getting a lot of people concerned.
105, Brent says to me the market is starting to wake up, that actually less energy will be coming out of the Gulf, coming out of the Strait of Hormuz anytime soon. When energy facilities actually start getting hit, now you have to add in another risk premium. And there is the USS Tripoli on its way to the Gulf. This is an amphibious assault ship. Those men could potentially be used to take over Kharg Island. Not saying they are, but now you can start to see if they're willing to hit energy facilities, potentially this could come next.
You wonder what the next steps are. So gas prices in Europe, European gas prices starting to climb higher as you get that bounce in energy, you get that pullback in stocks. That's the price action. Let's get you some morning calls. First up, Citi raising its price target on California resources to 67, calling it a, quote, prime beneficiary of surging crude prices. Your second call from Truist, raising its price target on Nvidia to 287, saying a growing backlog of demand suggests further upside. And your third and final call from TD Cowen, raising its price target on United Airlines to 140, saying higher fares will offset the spike in fuel prices. That name up again this morning by a third of 1%. Let's stick with energy. Oil majors hitting all-time highs as crude hovers near triple digits. Steve Richardson of Evercore writing, we continue to believe the market is underestimating the risk to global economic growth from this event and that this constitutes a regime change for energy equities. Steve joins us now for more. Steve, good morning.
Good morning.
Good to see you. What's your reaction to those headlines we just read out coming out of the Middle East?
Well, if you noted, it's clearly a change, right? The question is going to be for the market is how much of this is supporting domestic infrastructure, domestic power generation, which will start to put pressure on the regime, versus, you know, what we see as kind of an intractable situation with Hormuz that the market is waking up to.
The market's only waking up to this now. Why is that?
Well, I think energy people have been staring at the screen for the last couple of days, a little bit dumbfounded by that, to be frank, right? I mean, that's been the tenor of our calls, right? And I think that, you know, we see this dislocation between the physical and the paper market. We see, and I think it drives a certain complacency. As you mentioned, you know, the major oils are on their highs already. And so people, you know, struggle with what am I doing from here, I think a little bit. But I think that this regime change is really important. You got to remember that we've kind of asked the U.S. producers to kind of slow production pretty ratably for the last 3 or 4 years. And this does, you know, posit a significant change here.
If the U.S. is going to potentially do waiver the Jones Act, export controls even, what does that mean in terms of what the price could be in the United States versus the rest of the world? Or is there no way from ring fencing America?
It's a sugar high, right? It's a short-term Band-Aid. It could bring down, certainly you could bring down product prices in parts of the country, and that's, you know, obviously politically expedient. But, you know, we're speculating. We don't know. We could definitely can tell you that investors are concerned about this and what it means. The question is, do you do crude and products? There's a precedent for crude. Products are really what you need. And it would have ripple effects through Latin America, right, where we export most of our product. So I think it's, you know, it's something that investors are asking about, but I do think it's one of those things that would have a short term. It's a global market. You're not going to be able to fix this in any sustainable way, but could you do something for 30 or 45 days that would take the pressure off domestically? Sure.
This market has been incredibly contradictory in a whole host of ways since the war has started in terms of how it's responded. In part, the response by oil major stocks, equities, they're up 4% since the end of February, even though arguably they could benefit dramatically, and it could be a regime change. Can you explain why the underperformance of some other aspects of even equity markets?
I mean, I think, so a couple of things, right? I mean, I think that if you looked at the stocks year to date, one of the things that we'd point out is that it was really index run. Right, we had this SaaS meltdown, and you had capital almost moving one-to-one into energy if you look at the indexes. And then if you run those indexes, it was relatively indiscriminate, that buying, largest to smallest within those indexes. I think now you're getting some differentiation. The question is as this shows some duration, we see people moving a little bit down cap towards the producers, a little bit into oil services, which has been an unloved area of the sub-index. You got to remember, we're still 4% of the S&P. energy is. That also seems unsustainable in this regime change that we're talking about.
I guess it matters also how long it lasts, so that some of these oil majors can make plans to bring rigs back online. A number of rigs have not been online because of how low energy prices were heading into this. I just wonder, what's sort of the duration of this conflict? What does it have to be before the Mike Wirths of the world come out and say, all right, we got to ramp it up, we got to start producing more?
Right. I do think that's the dominant logic in the market, is this idea that you sell geopolitical risk, right? You sell the peak, and because things start to normalize and we go back to normal. The question here is what have we destroyed in terms of supply chains? What has been exposed as being an untenable risk, certainly for Asian economies? I think the U.S. producers will need to see oil make a higher low, if that makes sense, and some sustainability. I do think the back of the curve holding in the upper 70s or the 80s is an interesting signal. Think about it, U.S. producers, smaller producers could go and hedge that today and drill into that and make really interesting returns. So I think it will take a while, and it'll take investors a little while to kind of accept this too. So we wouldn't be surprised if we saw the first inklings of this late, within the next couple of months. Certainly a lot of investors will be asking about it. I do think as the time you get into the summer, we'll start to see the U.S. rig count move up. And I think that'll be the sign that we're going to start, growing a little bit in the U.S. again.
Steve, forgive me, I've only got 40 seconds. So it's an important question, though. How we value assets in different places, how is that going to change now? That's a core piece of the work you're doing at the moment.
Right. Great question. I mean, I think the simple question is if we are in a more inflationary environment and a higher risk environment, it's back to these tangible assets that the market has been very skeptical of what terminal value, particularly in oil, has been for a long time. And I think this experience is going to highlight the durability and the value of a lot of fixed assets of this nature.
Steve, it's good to see you. Thanks for being here. Reacting in real time to some of the news coming out of the Middle East right now. Steve Richardson there of Evercore. Coming up on the programme, we'll catch up with Aditya Bhave of Bank of America, reacting to breaking inflation data and another read on the labour market coming up tomorrow, going into a big Fed meeting later on this afternoon where Chairman Powell will do his best to avoid making any headlines whatsoever. So tune in for the decision at 2 p.m. and then tune in for that at 2:30 Eastern Time. Reacting to headlines out of the Middle East, the possibility, the potential of a new front in this war hits to energy assets. That conversation up next. Inflation data just moments away. We'll get to that in a moment. Mike McKee's going to go through the details for you. I want to start with the price action. Equities were positive. They rolled over just about unchanged on the S&P 500. Crude getting a lift just moments ago. Check out Brent. Check out WTI. Brent crude looks like this so far this morning, approaching 106, 105.80, up by 2.3%. And yields at the front end of the curve turn higher as well. At the very front end, twos at the moment, around 370. The headlines coming out of Axios that a senior Israeli official has indicated the Israeli Air Force struck the largest natural gas processing facility in Iran, located in the southwest of the country. The strike carried out in coordination with and with the approval of the United States. Those headlines driving markets in the last hour.
Because now everyone realizes that, okay, energy infrastructure is going to be a potential target for the Israelis, which have been going after top brass of the regime, and the administration, which mostly has focused on military assets and facilities. So right now what you have is several phases of the South Pars gas field hit by this projectiles, and they were taken offline to prevent fires. So this is going to have not just supply chain effects in the future, but also questions are remaining. What is going to be next in terms of the willingness for this administration and the Israelis to hit?
Gas futures turning higher off the back of those headlines as well as we get PPI. And Mike McKee, PPI coming in a little bit hotter than expected.
Well, actually, a lot hotter than expected, John. And as they say in the space biz, Houston, we have a problem. PPI comes in up 0.7% on a headline basis, which puts the headline number at 3.4%, up from 2.9% in January. These are February numbers. The core comes in, ex-food and energy, up 0.5%. That's down a little bit from last month's 0.8, but it moves the headline core ex-food and energy up to 3.9%. Take out trade services, and you've got a move up also of 0.5%, and that puts that number at 3.5% on a year-over-year basis. The composition of the numbers is not good either. On a for prices for final demand goods increased 1.1%. Prices for final demand services up 0.5%. So a lot of inflationary numbers in the February PPI report. And what's important is this, of course, feeds into the PCE numbers that the Fed cares about. We got a light CPI last week, but the categories that feed into the PCE were high. And I would imagine that that is the same story here in the PPI. And we may be moving up from the 3.1% core PCE number we saw in January to a much higher number in February. And all of this before the war started.
Mike McKee, that's just February. March is going to be ugly based on some of these moves we're seeing in the commodity market. Mike breaking it down for us. Mike, thank you. Futures turning lower then. We're down by 0.2% on the S&P. Yield started to bounce to the front end of the curve going into this print. Bounce even higher now, up by 3 basis points, north of 370 on twos. That's the upper end of the range over the past few weeks. We did get around 375, but these levels are around the highest levels we've seen since last summer, which was going into a rate-cutting cycle from the Federal Reserve. In the bond market then, yields up across the curve, but particularly at the front end. In the commodity market, not helping things. 106 on Brent, reclaiming a 106 handle just moments ago, higher by 2.6%. The headlines at the last hour, Lisa, uncomfortable for this Federal Reserve meeting later this afternoon.
Adding another element, another wrinkle to the energy shock that we're facing, given the fact that now we're having facilities being directly attacked. Taking a step back, it is difficult for this Federal Reserve to say that they are looking through the oil price shock when the benchmark core PCE and now PPI are coming in on an upward trajectory, when they're inflecting higher. So it is difficult to look through it when the underlying inflationary impulse running into this was already well beyond their 2% target. And that is going to be a very difficult message for them to really deliver later today.
We'll go back to Mike and get you some details in just a moment on the underlying numbers. Aditya Bhave joins us now, the head of US economics of Bank of America. Aditya, good to see you. Good morning.
Thanks for having me.
Your reaction to those numbers, how uncomfortable is that for this Federal Reserve?
So when it comes to the PPI, what markets focus on is the components that read through to PCE, which can sometimes be quite different from the headline figures. Still, Feb CPI, after that, market said, OK, PCE is going to be somewhere, core PCE is going to be somewhere between 40 and 45 basis points. So even if we land a little bit lower than that in the refined estimate after PPI, it's still, as Lisa said, a very elevated print. The last 3 months, Dec, Jan, Feb, you're probably going to annualize around 4.5% on the core PCE, maybe higher.
That's ugly.
That's ugly. You can explain some of it away with residual seasonality, idiosyncratic factors, but it's still way too high for the Fed. And as you said, it's before the energy shock in March.
Now, they've got to forecast what this is going to look like in months to come. As that inflation forecast comes out, most people assume it might a little bit later on this afternoon. What happens to the median dot?
The inflation forecast almost has to go up. I think the median dot, it's probably a bit too early for it to move, just because there's 9 months left in the year. We know that stagflationary shocks pose very, very bimodal risks to the economy. So near-term risk to inflation, but we understand that the labor market doesn't look so great either. If you think back to January, Powell told us the tension between the two mandates is decreasing. Since then, we've gotten this ugly inflation data, and at the same time, a weak Feb jobs report, and now yet another stagflationary shock, potentially a large one from energy. So I think their motto for the March meeting should be one battle after another.
What's the signal you're sending if you revise your inflation outlook higher and you leave the median dot unchanged?
I think the signal that you're sending is that this is a supply shock. So one thing they could do, for example, is raise their unemployment rate forecast. We don't expect them to. But what you're saying is this is a supply shock. We can look through some of it because we're also concerned about downside risks to growth and to, more importantly, the labor market. Also, just wait and see. I think that's going to be the message from Powell, as you were saying earlier. He's going to try and make this as boring as possible, and part of that is not moving the dots.
Well, the data is not making this boring, Bramo. PPI coming in hotter than expected. To Aditya's point, the labour market report came in much, much softer than expected. And in between, we've got a war in the Middle East, which is raging. The headlines are not encouraging this morning, and crude's elevated around 106 on Brent.
This is a terrible situation for a central bank. They're dealing with stagflation. They're dealing with a shock that is well out of their control. And it raises this issue of, do they signal an appreciation for past history, which is stagflationary trends can turn into a real downtrend for growth and eventually down the line for inflation? Do they balance out some of the hawkish talk with some of the disinflationary ramifications of higher energy prices?
Let's get back out to Mike McKee. Mike, I want to come back to you, sir. What are you seeing? What are you reading between the lines at the moment? Where is this move higher coming from?
Well, largely from goods prices up by the most since August of 2023. Prices for final demand goods up 1.1%, largely due to food prices rising. They were up 2.4%, led by a 48.9% jump in prices for fresh and dry vegetables. Now, there may be some tariff impact in there. But we also see in the goods prices a tariff drop for things like apparel and footwear. So there's a little bit of a cross purpose there, and we don't know what's going to happen once the IEEPA tariffs now are gone. But in terms of services, that's where the Fed is going to be concerned. They've been expecting that to start dropping, particularly because in the CPI, the housing numbers have been slowing. But in this case, 5.7% jump in services for travel accommodation, and that's the kind of stuff that does feed into the PCE. Also, brokerages and dealers on Wall Street, those prices are up, and that also feeds into the PCE. So we are seeing some problem areas for the Fed going forward, and it is, if you want to look at it this way, what would the Fed do if there weren't a war on? Right now, when you see these kind of prices, they might be considering at least mentioning the idea that rate increases could be down the road.
Mike McKee, thank you, sir. Mike McKee breaking down the inflation data. Aditya, your response to that. What would the Fed be doing if there wasn't a war right now?
If there wasn't a war right now, I still think they would be on hold. We didn't see a strong reason for them to cut, at least in March or April, just based on the underlying activity data having pretty solid momentum, fiscal stimulus kicking in, tariffs going down, and inflation still being somewhat sticky, as we discussed even before the war. So the outlook potentially changes in June, because then we'll have different leadership at the Fed. But until then, for this meeting and the next one, we feel pretty confident that with or without the war, they were not going to cut.
If they signal cutting rates later this year, do you think that that could send a real sell-off in the long end of the yield curve, given the fact that it might suggest that this Fed is disproportionately dovish in the face of not just an oil price shock, but the underlying inflation currently in the economy?
To be entirely honest, I think the market already understands that this Fed does tend to lean dovish, that a majority of voters on the FOMC right now are probably of the view that neutral rates are closer to 3 than 3.5%. So rates, they think, eventually do need to come down. And I honestly don't think markets paid that much attention to the dots as early as March.
You know, I like to benchmark to the extreme. It is not a good strategy in markets, but if one were to benchmark to the extreme, they start to look at the setup of supply disruptions, an oil price shock, and then already an economy in flux with heated inflation percolating up, you'd start to harken back to the 1970s, and you'd say, this does have some of the elements of what we saw back then. What's your pushback to that?
The big difference between now and the 1970s is that the U.S. is energy independent. We're a net exporter of energy, and the economy has also become a lot more energy efficient. So the share of energy goods and services, not just gas, but utilities and so on, in total consumer spending is much, much smaller than it was in the 70s. So if you look at the direct pass-through of oil prices to energy to headline inflation, it's actually quite small. The concern here is second-round effects. There's two ways in which that works out. One would be broader supply disruptions that you were talking about earlier. How will those affect core inflation? And the other will be what happens to the labor market. Do wages start to go up? That, I think, would be the other concern for the Fed. If not, then I think you can look through the inflation impact and focus more on the downside risk to growth.
Aditya, you're right. We're number one in crude. We're number one in a number of products. We're number one in natural liquefied gas. But it is traded on a global market. So prices continuously are going to be elevated, and we're seeing that already in gasoline and diesel prices. So I know it's a little bit different in the 70s in terms of the complex and the makeup of where the physical products are, but this is going to have still cascading effects.
Sure. So the difference is that the headwind to consumers, that's still there. But one, that headwind is smaller because consumers spend a smaller share of their wallet on energy goods and services. And secondly, that headwind is somewhat offset, at least partially, by a tailwind for producers, windfall profits from higher prices.
Aditya, it's good to see you. Thank you, sir. Aditya Bhave there of Bank of America. In the last hour, the headlines have not been kind to risk assets, that's for sure. Headlines about strikes on energy assets in the Middle East, and then a much hotter than expected read on PPI as well. This is what it's doing to financial markets. Equity futures were positive, and now they're slightly negative on the S&P to unchanged, somewhere between the two. In the bond market, at the front end of the yield curve, yields are somewhat elevated. On a 2-year bond yield, they were slightly lower, now higher by 3 basis points at 370. Going into this Fed, we've got energy prices bouncing, Bramo, Brent around 106. Gas prices inflecting higher as well.
It's all going to make it a lot more difficult for this Federal Reserve to take a dovish stance on any of this. I'm looking right now at Fed funds futures, and now we don't even have a full rate cut getting priced into the market by the end of this year. How exactly do you lower rates when faced with a benchmark inflation rate that is hotter than expected, as well as an oil price shock? Right now, this is the concern. If you get a Fed that pushes back, does that start to inject some risk into credit markets and start to force the credit transmission to pressure growth even lower? And that, I think, is the concern of a lot of people in risk markets.
The concern I've got is this is February data. Wait for March.
Exactly.
This predates the big move we've had in crude and energy prices more broadly. Annmarie, the headlines keep coming.
Right. Israel's now saying that they are confirming to a source confirming to our colleagues that they carried out the strike in Iran's South Pars gas field. Iran is saying they're going to retaliate against the attack on energy infrastructure. You know, the president, when he talks about Iranian natural gas, when he talks about oil, he says Karg Island is the crown jewel. Well, South Pars isn't that far in terms of a crown jewel. This is the largest gas field in the world. And when it comes to domestic consumption in Iran, it accounts for 70% of their domestic concerns in Iran when it comes to natural gas. So this is a huge blow to the regime, but also you see that the energy markets are picking up the concern.
Brent up 106. WTI, the last time the Fed met that morning, WTI 62. This morning, just short of 97. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Israel striking the largest gas processing facility in Iran, Axios reporting, and as we just confirmed, Israel carried out the attack in the southwest of the country with the approval of the U.S. It marks the first time Iran's upstream oil and gas facilities have been targeted so far in the war. Brent crude up 3.3%. The U.S. Navy's most advanced aircraft carrier is retreating from the Middle East after a fire broke out in its laundry room. The incident left at least 2 of the USS Gerald R. Ford's crew members with non-life-threatening injuries. The ship is heading to Greece for repairs, leaving only 1 carrier to support U.S. forces in the waters around Iran. And Japan PM Sanae Takaichi warning she's facing a, quote, extremely difficult meeting with President Donald Trump tomorrow. Her comments coming after President Trump criticized Japan for rebuffing his demand for warships to help secure the Strait of Hormuz. That's your Bloomberg Brief. John.
Hey, Yahira, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Kelly Kowalski of MassMutual, counting down to today's Fed decision. Yahira is going to have your morning movers in just a moment. Shares of Macy's rising after earnings despite caution from geopolitics. The geopolitics driving this market big time.
You know what I wish the Fed would do? I wish they would put out a statement and say, folks, there are just some things that we can't solve. Not be hawkish or dovish, but be honest and say, folks, we just, this is a problem created by geopolitics. All we can do is leave the rate right here and see how things unfold.
Ed, I'm with you. Cancel the meeting. Ed Yardeni of Yardeni Research. Just call it off.
Yeah, it could have been
no
an
news
email.
Conference. Just let it go.
I'm sure that Jay Powell agrees with you.
He'd probably love that, wouldn't he?
He would absolutely 100% do that if he could.
This Federal Reserve is in a very uncomfortable spot right now, getting squeezed by the data and the headlines. PPI coming in hotter than expected about 20 minutes ago, and these headlines keep building. Signs and headlines, evidence of attacks on Iranian energy infrastructure. Claims from Iran that they're vowing to retaliate and target energy infrastructure and energy assets elsewhere. A strong suggestion coming from the Iranian government that will happen. And this from Axios, which I think is really important. Not just the damage to Iranian infrastructure, but who did it and with cooperation with who. Executed by the Israelis, carried out in coordination with and with the approval of the United States. That is an escalation in the Middle East.
With the approval of is really something, because this means potentially other Iranian facilities like Karg Island, which the president was very clear when he speaks about it, was not going after the energy facilities there, just the military installations there. Potentially this is going to be next to come. And potentially this is start of a new phase of this war. And that is why you're seeing gas futures higher, and that is why you're seeing Brent crude higher.
Brent 107, WTI 97, pair it with what we're seeing in the data, PPI coming in much hotter than expected. You've got yields at the front end of the curve higher by close to 4 basis points now at 371, and equities declining on the S&P, now down by 0.5%. All of that basically in the last hour. As we count you down to the opening bell, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. After a more than 500% surge in its market debut, shares of Swarmer are up another 25% in the pre-market. This is the company that makes the AI software that coordinates drone swarms used in combat. And with the Iran war front and center, you can see how investors are leaning into this theme of higher defense spending. Moving on to Macy's, who had earnings just earlier. Shares are up 6% off the highs, but it was a mixed report, but investors obviously leaning into the good parts of this report. It was a beat on both comparable sales and profits in the last quarter, but it struck a cautious outlook on the year ahead, calling it prudent, calling its outlook prudent, saying that macro and geopolitical risks will weigh on spending. And it's been the year of memory chip stocks with all these names of Micron and SanDisk higher. Western Digital now turning negative ahead of a big test later today. We do get Micron reporting after the bell, and with that stock up 60% year to date, it will be all about whether it can deliver. John?
Yahara, thank you. Appreciate it. Let's get straight to it. Kelly Kowalski of MassMutual joins us around the table. Kelly, good to see you. Your thoughts on what's happening with this Fed? Investors were already coming into the March meeting expecting a Fed on hold, and that hasn't changed post-Iran. If anything, there's less room for disappointment. Are things getting harder this morning?
I think so. Look, we're in the fog of war. I think the Fed's in the fog of war as well. You know, the last 2 days we've seen market strength, but we have to continue to expect this. The headlines are going to sort of drive short-term moves. And I think looking to today's Fed meeting, you know, at the end of last year, we had one cut in the dots coming into this year. We really don't expect that to change, just given how new everything is. And look, this crisis has been going on 2.5, now almost 3 weeks. So still very new, and we kind of expect that sort of more balanced approach from the Fed and not really committing, you know, one way or the other in terms of inflation versus the labor market side of the mandate.
What's the argument against the Fed putting a rate hike back on the table, given the fact that when you take a look at PPI, without stripping out food and energy, it's at the highest level in about a year. You're seeing a lot of different inflationary metrics moving upward even before this oil price shock.
It's the other side of the mandate. Right? There's the inflation side and there's the labor market side, and the labor market is fairly weak. So I think they really need to preserve that optionality, even though we are likely to see inflation prints. They're not going to say it's temporary, but if you look at the way markets have been, you know, relatively resilient, markets are viewing it as if it's going to be temporary. But again, there's the risk of that, the demand destruction side, which I think the Fed has to sort of keep that on its mind.
When do you start recommending that people start thinking about the possibility of recession more than currently being priced into risk assets?
Well, look, we came into this year, you know, data's been okay. You know, we know the labor market's been weak. PMIs have been increasing. We've seen industrial production picking up. It's, again, a little bit premature for that. But the longer this, you know, crisis, war drags out, the more we need to think about it. Right? There's the first order effects of oil prices, but there's sort of the second and third order effects, which build the more prolonged this is. Again, I don't think that's priced in, where there's definitely a longer tail if we think about it. The tails are fatter now. But again, markets are really not trading on that narrative.
As Lisa mentioned a few times in the last 24 hours, how much confidence can you take from what we're hearing from the airlines, that the business for the likes of Delta and American has been pretty decent, and they're projecting it to continue through the first quarter?
I think that speaks to the ongoing trend we're seeing of sort of the K-shaped economy, right? You're seeing a pull forward in demand. We're expecting airline prices or airline fares to go up. So that gives us some confidence that the upper 20% spends less than 2% of its income on fuel. You go to the bottom 20%, it's 6 to 7 times that. So you're going to see more pressure on that lower end. But the question is, can this upper end withstand these higher fuel prices? Probably.
This is going to squeeze a lot of people. Kelly, it's good to see you. Thank you. Thanks for being here. Kelly Kowalski there of MassMutual. If you're just joining us, what a couple of hours on this programme. This Fed is looking increasingly constrained by the headlines. Escalation in the Middle East, and going into the meeting, a much hotter than expected PPI print. Coming up later, 2 p.m. Eastern Time, your lineup for the surveillance special looks like this. The Fed decides. We'll be catching up with Bob Michael of JPMorgan, Subhadra Rajappa of SocGen, the former Fed Vice Chair Rich Clarida, Torsten Slok of Apollo. We'll see you later this afternoon from New York. This was Bloomberg Surveillance.